New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan as we take you through the rest of this trading hour, about 55 minutes to go until futures close for the session. If you're on the website, on the platform, come over to YouTube. Tell us what you're trading, what you think of this paint drying kind of day. If you're already there, you're not familiar with us, come over to tastylive.com, see what we're all about, get familiar with the platform Tasty Trade. Ilya, we're going to have some cool things to talk about in terms of new products on the platform soon, but not quite yet. So be sure to stick around for that. In any event, as we make our way into this trading session, it was a day that kind of came and went. Markets largely unchanged from where they were at the midpoint of the session. S&P 500, we find ourselves up by about 0.25% right now with a little bit of a squeeze there into the close, 58.28. NASDAQ up to 20,500, a gain of about 0.6%. The Russell on the flip side down by about 0.6%, a move back into tech away from small cap. Suppose that's a good sign. Ultimately, we see bonds move off their lows. We do reverse around that 116.5 level in ZB. 10-year yields, they make a new weekly high, but then again, reverse lower. Gold up modestly, but silver and copper up over 2% respectively. Oil was up, then down on the Black Sea news, now back up modestly, while natural gas falls apart and kicks me out of a position. Dollar index, meandering. It was a meandering kind of day here, though, Ilya. Mm-hmm. As someone who's now watching the market, waiting for a rebound to sell into, have you seen enough to get back on the short side?
Come on, Ilya, let's get short. Let's do it.
No, I don't think so. I think we have room.
Little devil on the shoulder action there.
Yeah, come on. I did.
What else are you going to
add to my bonds position today?
Sorry, the man is trying to speak. You added to your bonds?
Yes. So I got more risk off in a sense. So I liked this bounce. I liked that it held support. So I bought more TLT call verticals. They're cheap. You get good risk reward, 52 days out. So I'm giving myself all kinds of time. The vol there is priced really well, so you can get almost 2.5, 3 to 1 reward risk numbers. Why not? My existing TLT exposure has about 28 days to expiration. Now I get to lock in a little bit more exposure for longer. So I'm looking for the bonds to bounce here. For stocks, it's really difficult to want to step in front of this because there's no discernible reason why you should. I was looking at maybe getting long the Russell here today, but again, the vol is elevated enough that any way you slice it, the risk reward isn't good. You want to sell a put vertical, 1-to-1 risk reward and less than 50% probability of profit. Do you want to get long calls verticals? Same thing. So the market is very clearly telling you if you want to chase this thing higher, you're going to have to get upside down on risk reward to do it. And my answer to that is, no, I am not. I'll just continue to sit on my hands. So I don't think the market is telling you it wants you here. and fine, I'll wait. For me, the bogey on the S&P, the bogey on the NASDAQ is still those lows from the beginning of the year that we took out, though, that range bottom from January. That, I think, is where you look for if you want probably the place where this stops. Now, maybe it stops earlier, but show me a red candle and then I'll believe it. But in the meantime, we've had a period of consolidation. We've taken it out. We've not come back in on it. So why wouldn't we now go to the next inflection point, which, I mean, if you're looking at S&P, if you're looking at NASDAQ, for NASDAQ, you're probably looking at something like 21,000, 20,000 920, something like that. For the S&P, you're getting closer. It's maybe a range of 58.60 to 59.20, so somewhere around 5,900, give or take 10 or 20 index points on either side. So you're closer. You're getting there. Let's get up there. Let's get some shooting star candlesticks up there. Let's get some dojis. Let's get some signs that momentum is ebbing. Mm-hmm. And with that, you should get more vol crush. So the pricing should get better. And then we're buying put verticals.
That to me seems like the sensible course of action, Dylan. We're at a 17.
I mean, who needs it? I mean, it's so boring. We're going to buy TLT call spreads and wait it out. Mm-hmm. I mean, I might as well go paint the bathroom.
Honestly, next time I'm in New York, we're literally doing that right now. We're trying to decide on the paint color. So if I could pencil you in, perhaps in like 3 weeks, we'll have the color picked.
I once painted the same Manhattan apartment. My room was my first college apartment. Little sidebar, because who cares if markets screw dots anyway today. So my first college apartment, my roommate and I decide we're going to paint the bathroom. I don't know why. Probably raining or something. We probably smoked pot. God knows. But we were like, let's paint the bathroom.
Valid reason to smoke pot. It's raining.
I mean, if you've been to New York recently, you don't need a reason.
You can smell it everywhere now.
In New York now, you're forced to smoke pot against that's a different topic. You're forced to smoke pot against their will. I have friends of mine parents who are raising children in Manhattan, and they say, if you smoke pot, make sure you never pay for it. Just walk around. If you want to smoke pot, don't pay.
You finally caught up to where we've been in San Francisco all these years.
Yeah, exactly. Anyway, we once painted the same bathroom 4 times in the same day because we kept resulting with colors we didn't like. And ever since then, I've just painted everything and anything, or requested others to paint it. I'd be more accurate, but white, off-white. After that one moment, I don't play around with paint colors. Never will. Done.
Like a glossy finish or
eggshell white, sometimes a semi-gloss. Like or museum white. It's different. The ceiling, the molding. You can do various treatments, or whatever it is, textures, I guess.
You got to go for the semi-gloss for when your children write on the wall so that you can wipe it off.
See, there's reasons. There's reasons. But anyway, listen, maybe I should buy the TL. I think I'm probably just resentful of the fact that Ilya has got that TLT going and I don't. I think maybe I should just join the party and calm down.
Figured I put up a Home Depot chart while we're talking about paint. That's up off the lows here today. Yeah, I'm like,
it's all relevant.
I'm trying to like incorporate some British racing green into my home somewhere, and that's proving challenging. But it's like British racing green is the most aesthetically appealing green, I think.
Well, good luck. I mean, whatever. Hopefully you're better off than me. I've seen people successfully do all kinds of things, as all have, I'm sure. But sometimes you pick just one wall. You could pick like one wall and make that British racing green, like just a single, like everything else stays the museum eggshell white. And then just slap one wall of British racing green in there just to let them know that you're wild and crazy.
Yeah, or like this candle.
You'll have an automatic green screen.
Well, this would be the candlestick green, right? That's the color I should paint my house. I'm such a bull, right? Just everything is candlestick green.
There you go.
That would be.
What are you doing in here, honey? Why is every wall in the house green?
I've painted my house brown. Why? Because I'm directionally agnostic.
You're like, because I went ape shit long in November 23, and the reason we have this house is because of my ape shit position.
We see a stock market here today that's ultimately churning, if you will. Ilya, Tom was noting that the front month VIX futures were showing a little bit of a rise here at the end of the day. He was wondering what that could be about if there's an event over the next few days. We do have durable goods tomorrow morning, which for
I guess
all considerations, that's probably the most important piece of data this week, alongside jobless claims, perhaps left on the calendar.
Unless the PCE does something very strange.
Which I guess we can't rule out in this environment. But durable goods items, lifespans 3 years or longer. You typically just don't put out a big cash outlay to buy those things. They might require financing, airplanes, automobiles, appliances for your home. It's a good health check on confidence for consumers. I'm not going out and buying a new vehicle or a new appliance or getting a new airplane unless I have confidence that I can, make the cash flow payments necessary for the financing, or that I know business will be there in the future to justify the expense. Are you looking at this durable goods report tomorrow morning as another one of those signs that we see deteriorating confidence and momentum in the economy?
I don't think it's the kind of thing that can move the needle. I mean, I'm always looking at all the economic data for just a tracker and for semi-academic reasons to basically know what's going on and see how it can filter into other things. And of course, if you do get some sort of crazy outsized number, you wouldn't know it if you didn't see it. So I am, of course, going to be watching it, but I don't think it's the kind of thing that really moves markets. The Fed and the market are at equilibrium here. They've basically arrived at the same spot. The markets are a little bit more urgent. They want maybe 2 erring on 3 this year, 1 erring on 2 next year, whereas the Fed is equal weighted, 50 basis points this year, 50 basis points next. But on the whole, taking sort of liquidity and market fuzz out of it, the Fed and the markets agree. And so there's not a strong impetus for something like a durable goods unless it really is haywire, unless you get a real wild deviation from forecasts. There's no reason to think it should really change the landscape until you get to substantive numbers. And you sort of got that from Powell last week. And I think that's how you end up basically at this equilibrium. Is Powell said, look, we hear you. We see it also. But we're not seeing it in the kind of data that would scare us. It's all survey stuff now. What if these people calm down in 2 months? Like, let's see it actually show up in hard data where money has moved or it hasn't. And durable goods is that kind of data. So there could be something there, but I think what we're really after is a jobs report. And that's end of next week. That's where you get a catalyst where you could actually get the markets to rethink their Fed idea. In the meantime, unless you get something wacky from Washington, D.C., or some of these kind of secondary indicators like a durable goods is wildly off the forecast, which is inherently, by the way, unlikely. These forecasts are medians of huge sample spaces. So rarely would you get a really, really wild deviation. And sometimes you do, and when you do, the markets react. So in the unlikely event that durable goods is way off sides, it'll move things. But I don't think that's the path of least resistance here.
Dylan, what are you looking to for the second half of this week as we make our way through Wednesday, Thursday, Friday?
I mean, my biggest thing is I'm sort of I like the idea of oil going lower, and then the Mag 7. I'm hopeful for the Mag 7 with my Amazon proxy, but it could be any of them. But weaker oil, or at least sort of not higher oil. I did sell the call spread in there. I sold the call spread in oil on the USO, and then bought the Amazon call spread. So short the economy and short Donald Trump's tariffs would be the way that I would say that a slowing economy will express itself in oil, although I could probably just as well be doing TLT call spreads to do that maybe more efficiently with less of a distraction from other non-economic things. And short the Trump tariffs by way of the long Amazon position, which I probably could be manifest, in a variety of other ways. But anyway, that's where my head is at. Short the tariffs, short the economy, or short the economic growth, I would say.
Right. And so perhaps a layer to what happens in crude today is the announcement that Russia, Ukraine, United States have come to some sort of ceasefire agreement with respect to energy infrastructure as it pertains to the Black Sea. Now that you're back in Europe and you're adjusted to the time you've been out in the world, and you look like your full spry self, what is the world over there saying about this deal? What are the next steps?
About which deal?
The Russia-Ukraine ceasefire. Is this a big deal for Europe that we're moving into a period of calm?
All the conversation is about the defense boom in the Germans. I had a nice long lunch today with a couple of big.
This is what I want to hear.
Yes. Big. I had a long lunch today with two big financiers out of London, Italians who were running a big bond fund out of London, who recently moved back to Milan, who also own a large materials manufacturing plant in an area called Marche, whatever. It's like east of Rome, but it's a big European. It's basically in the defense industry supply chain, and everyone, according to them, I mean, so this is taken as one anecdote, but it's that basically everything is revolving around the Euro boom. Europe's about to go bananas in terms of economic spending, which everybody knows, but that it's going to be a big boom. Everybody's expecting it to be a big boom, but even that the Canadians were reaching out to the European factories, offering incentives, basically saying if you form a subsidiary in Canada of your European company, especially manufacturing, production, and that kind of thing, we will give you government money to build your factory because we're looking to do any deal we can to circumvent America. That they're basically, that Europe's going to boom, not just because of the domestic spending boom that's going to happen on the continent as a result of the remilitarization of the continent, but also because the other non-European entities are looking for alternatives to U.S. technology and manufacturing to incentivize in Canada, in other countries. I don't know the other countries, but I'm sure other countries. And so I just think that it was something that I didn't consider. I think that the defense boom is obvious. I didn't consider that there was solicitation, that there were opportunities for European manufacturers to grow outside of Europe because of the incentive for non-U.S. countries outside of the U.S., outside of Europe, soliciting European technology and innovation companies to grow in their country.
This probably extends to Australia, probably extends to New Zealand, probably Japan, probably South Korea. Japan. So the entire this
company just did a big deal in India.
Yeah. So basically the U.S. alliance ex-U.S., the traditional U.S. alliance ex-U.S., call it Four Eyes, and sort of the adjacent. They probably are looking to kind of say, you know what, in the event that the empire becomes aloof and stops picking a side and just starts becoming a transactional character, we need to secure our alliance amongst ourselves.
I mean, I would say that I've not seen this level of optimism for European economic. So it was two headlines. One, the most optimistic I've ever seen European businessmen be about economic growth in Europe, which is also why we've already seen all the stock market. So I won't recount, but we know the market's up 20% in 2 months or whatever across the board. But also there was the natural anxiety because there's it's a joke, but it's not really a joke, which is there was once a time when Germany, that basically there's three kinds of Germans, because every European country is ultimately tribal. So you have Saxons, Prussians, and Bavarians. Anyway, I won't get into the sort of the refinement of that, but the point is that there's one country on earth that has ever gone to war with the entire world and almost won. So like Germany's the only country that's like this little country, and they were willing to go to war with the earth and they nearly won. And so like the comment was, I don't worry so much. This would be a quote from lunch. I don't worry so much about Trump because I think he's mostly all talk. But I do worry about Germany because they actually will take more formidable action than any country in the world once they engage.
And this is really the conversation that we were having yesterday and that I've been having basically since college days, and that I am going to have on Macro Money tomorrow. This idea that the way the European Union makes sense and the way that the Eurozone in particular makes sense cannot be understood with economics. But once you introduce the idea that the absence of Franco-German war, basically, is an economic good, that all of a sudden European integration makes a ton of sense. And you take Robert Mundell's optimum currency area modeling for what a country would need to join and basically tie up its monetary policy with another in a single currency or a grouping in a single currency. And the calculus on economics makes no sense in Europe.
No whatsoever.
The economies are too different. I mean, obviously, we saw this in 2011, 2012 in spades. The whole thing was about Greece and Germany need different interest rates. They need different policies, and the whole thing almost came apart. But when you introduce the collective defense and most importantly German containment into the equation, that's an economic good. That's a benefit to long-term economic stability, because Germans aren't going to roll your infrastructure over and disrupt your economy every X number of years. That then it makes sense. And in this current context, the way this looks is, yeah, maybe mutualization of debt, maybe big deficits, maybe the kind of deregulation that the Eurozone and the EU has needed for decades now was elusive because nobody was bought in. But now that it's a defense objective, everybody's in. And they will get this done.
I mean, my thought, I don't disagree with anything that you just said, and I think that that's it. But let's assume that probability, that's an underlying force here.
Mm-hmm.
Why not invest? I don't know if it's tradable because of liquidity and all the rest of it. Mm-hmm. But how is now not a good time to increase your financial exposure to a European index? Maybe you don't pick a country, maybe you don't pick a sector, but it's hard to see how there's not going to be 2 to 3 years of boom in the equity and European equities.
I like that idea. I like the idea of being long the euro and being long the pound, obviously, around these sort of reasons. And actually, I think the currencies might make more sense than the indexes, at least at the moment.
As tradable, right? There's a difference.
Yeah.
If this was just I want to go out there and own Europe, I could just go buy EZU. But in terms of that being cost
or
effective,
FEZ, whatever,
right? Or FEZ, right? Like as an investment, right? But as a trade, I think the point you're getting at is the
VGK, whatever.
Yeah, the currencies themselves, at least right now for the futures, although maybe more coming to the platform soon, that's probably the best, most direct, cost-effective way to get some exposure here to anything in Europe right now. But, we could go through a period where the euro would just move sideways and European equities are continuing to climb. We can't discount that either.
So the euro's been my best trade so far this year. Being long the euro has so far been where most of my money this year was made. Having gotten short equities before the rollover of the calendar year near the top and sold out before this kind of bounce consolidation, whatever this is, the euro still has done more. And I'm out now. I got out earlier this week out of all of my dollar shorts, but that's not because I don't believe in it. It's because I think it's a little bit rich here and it started to come back some. As soon as it finds a bottom, let's go. I think the indexes at this point look like they're stuck a little bit. And the thing with EZU and with something like FEZ, with, I believe, VGK as well, which is UK and Eurozone, I think here...
FTSE European ETF, yeah.
Yeah. Here, I think these are dollar-based ETFs. So you're not getting the FX exposure. If you wanted both, you could do both.
Mm-hmm.
And
that's the difference between HEZU. That's the difference between HEZU and EZU. One is currency hedge, the other isn't. So if you want to own European stocks in euro, you're going over to EZU. If you want to own European stocks in dollars, you're going over to HEZU. So that's part of the reason why EZU has exploded this year.
The other thing is, go for it. Because you could also start to drop into the European defense contractors.
Yeah.
If you really want to get, now I know it becomes inaccessible from a trading perspective, but that's where the money's
there's definitely some names out there, like Rheinmetall is huge. I mean, at this point,
it doesn't matter if the tariffs don't go into effect.
Well, that was the point of my lunch. Sorry to interrupt you, Chris. Where it's like Trump, nobody listens, but the Europeans have accepted the fact that America is not an ally.
Right.
America is threatening to invade Denmark. Canada's in the same boat, and that's like, and the Germans and the Italians and the French, when they lay out $1 trillion budget and a 10-year plan, that's different than tariffs on Monday. No tariffs on Monday, or Howard Lutnick or Elon Musk shooting their mouth off on Twitter. That's not what this is over here at all. This is a slow is fast mentality of, okay, it's over. U.S. is now a Russian ally. It's openly threatening to invade Denmark. And we need to build our own army. We got it. I mean, even like I don't know if people saw the leak from the Signal chat with the J.D. Vance and the defense secretary, whoever else. The thing that stood out from that chat, other than the obvious thing that it was even existed and we could see it, which is a different issue, was how openly hostile the conversation was to Europe. It was a fuck Europe vibe, literally. And so you don't think everybody sees it's not, if we're seeing that, you don't think they see that in the Bundestag in Berlin, or in the parliament in Paris, or in Rome, or in Eastern Europe, in Poland. They see it. So, again, but my intention is not to drive us towards a geopolitical conversation. My point is I believe there's about to be a level of economic spending and activity in Europe, the likes of which probably has not been seen since right after the Eurozone, like right after 99, maybe there was a bunch when the currency came together. And I don't even know that that's true. And it may be a structural investment worth considering. I don't know the tradability. I guess the question would be, can the euro go back to 130, Ilya, where it was, 20 years ago or something? 15 years ago?
I don't think that that's impossible. Obviously, I think we have to reckon with the idea that Europe would need a tremendous amount of structural work to get this stuff done.
You mean because of the demographics? You're saying because of the aging population?
Because of the demographics, because of the aging population, because they still don't have debt mutualization, because they are creaking under ridiculous administrative and regulatory burdens. Obviously, not to suggest that I have an opinion on Brexit here. Obviously, I am not in the UK, but the gripe from those people that I have been talking to and have been talking to for years that were free market Brexiteers, that were Brexiteers not because of immigration, not because of anything else, but because they wanted the UK to be more free in its trade, more free in its rules, more liberalized economically, not less. Those people were saying, well, the reason we want Brexit is because the Brussels bureaucracy is a hassle and it's holding us back. So if Europe is really about to embark on the kind of wholesale revision of Europe as a project and really do all the things that Mario Draghi wrote up for them in that big report he submitted last year, we're about to look at something. And by the way, I think the likelihood is yes. I think the likelihood is, much as Japan awakened a sleeping giant in the US in World War II, Russia has awakened a sleeping one in Western Europe. And now we're going to see rapidly all kinds of opportunity in Europe. We do have to pace ourselves, though. And so I think right now the impressive thing for the Europe to do, or for the euro to do, would be to get to like 113. Let's get
just to break that 90 cents you're saying.
Yeah, let's get to 113.
Right now it's going the other way. I mean, how do you look at the reversal here at the moment?
So I'm looking at support here. If you look at where the euro is, and I think, Chris, we had this line on the continuous contract. It's built from the low in August, August 1st of last year.
There you go.
And exactly. And that's where we're sitting. We've got to either hold that or take that out. And right now it's unclear. I would not be surprised, by the way, either way. But you tell me that it's held, and you show me that it's no longer setting lower lows and maybe sets a higher high on like a 4-hour or an 8-hour chart, I'm long. This thing breaks down back to like 105, 104.50. That's the next barrier. I look for a buying opportunity there. I'm not selling.
I mean, isn't it part and parcel to the Trump strategy to have a manufacturing revival? You're going to need a weaker currency, right? Wouldn't they welcome the fact? Isn't the worldview that these other countries with their trade deals, they've allowed their currencies to weaken, and so we're buying all this crap from them, and they're not giving anything back to us, and so we're basically subsidizing them, and so they can't have weak currencies anymore, right?
Well, and to give the Trump administration some credit. They've been saying since the first Trump administration that they want NATO to do their part on military spending and to rearm. And it's different this time, though. That we still were in like a peacetime arrangement. No, I know, but I'm saying that it didn't. They promised it last time and didn't do it. And now it seems like, as a lot of what this administration is doing, they're saying, okay, well, you know what? Good cop, bad cop. The first administration was good cop, if you can believe it. This administration is bad cop. And now we're going to compel you. And we're going to compel you by all of these things. Mm-hmm. And it's working. Now, does it end up being that the risk reward on this kind of action is actually off? I think you and I and Dylan, you would argue that the risk reward is off, that it's not worthwhile to go this hard because of the long-term consequences and because the cost will ultimately be greater than the benefit. But that's not the way that this administration, I think, looks at it. They want a rearmed Europe, and they didn't get it last time with a conversation. It looks like they're trying to do it now at the barrel of a gun.
A rearmed Europe is the only way that you can take on China in the future.
Yeah,
America right now can't take on China by itself. Like it would need if there is a
Germany can take on the whole world by itself.
But
not today.
But not today, right? You know, that may have been one of the pieces of information that I saw some people complain like, oh, Hezget's so arrogant that he would say like America's the only one on our side of the ledger that can accomplish what they wanted to accomplish in the Red Sea. No, that's legitimately true, There's no one else in the world.
He's not wrong.
There's no other superpower.
His delivery is untoward, but he's not wrong.
Right. So if there's an invasion of Taiwan or Japan by China in some future scenario, or of Korea, what help can Europe lend right now? They can provide support troops. They can provide some support munitions. We saw what happened in Afghanistan and Iraq, right? But they're not going to be deploying 250,000 people. They're not going to be deploying 500,000 people. They're not going to be deploying, armaments and mechanized
the other
tech.
Discussion, not to go back to this one lunch with this one defense contractor, Europe's plan is the most formidable drone army the world has ever seen. They know they don't have soldiers. So their entire focus is aerial and robotics at mass scale.
The world's museum may become the most advanced military tech
it's starting at
operator.
zero, and they know they don't have soldiers. So they know they're not going to be able to compete on a body count. So their whole thing with the defense contractors is the world's most advanced robot and drone army as soon as possible. For sure.
It's a shame that American companies like Anduril aren't going to be able to, participate in that, because there's very few people in the American. Look, with the new F-47s, which, by the way, that's a great double entendre. F-47. We can surmise that when he says things like, yeah, our allies aren't going to get the full package, they're going to get a toned down version of the plane. The reason why these defense contractors,
when you name the plane F-47 because you're the 47th president, it's like a kindergartner became president of the United States.
Yeah, but Dylan, I know that you in the mirror sometimes look at the news today, F-47, right? So it's a funny double entendre. Right? It's a funny double entendre. But you think about the defense contractors here, the whole point is that you have these contracts with them. America provides your security blanket. We'll protect you. Also, protect yourself. Buy some planes from Lockheed Martin. If we're going around telling people we're actually not going to give you the full features, and we retain and reserve the right to turn off some of the features remotely.
To turn off the software.
Why the hell are they going to buy a single thing from us? Now, I know there are people who say the U.S.
It's a first offer.
Listen, the military-industrial complex, as Eisenhower warned, has become expansive, unwieldy. We spend more money on defense spending than any other country on the planet, and more than I think the next 5 or 6 behind us combined. It's unwieldy, it's unruly, but it provides the world a peace dividend. That's the trade-off, right? These other countries don't have to pay the spending because we provide the security blanket. We keep the world's naval lanes open for commerce. Right. One of Thomas Jefferson's first actions as president was to fight pirates off the coast of Tripoli. That's why in the song we talk about Tripoli in our anthem, right? Because Jefferson sends to fight off these pirates because it's disrupting American commerce. And maybe you could argue that globalization has hurt the American economy in some ways. I certainly think so. We've all seen the elephant graph when you look at the decile distribution of where wages have gone over the past 40 years. The people globally in the 70th, 80th wage percentile have been hollowed out. Who's in the 70th, 80th wage percentile globally? The American middle class. So there is a legitimate problem here that we have not accounted for. I happen to think this has been a deliberate hollowing out of the middle class. China didn't steal these jobs. Our politicians and corporations willfully worked together to allow labor to be held overseas where it was cheaper and more profitable. But LMT, Lockheed Martin, Raytheon, these other companies right now, what they're going through, it's a crisis in trust. You can't trust an American arms manufacturer right now. And that's going to be jobs lost at munitions plants across the country. I have friends who work in munitions plants up in Massachusetts. They're already talking about how their orders are starting to be cut. And this is the guy who always texts me hey, by the way, Chris, we just got a big order for bombs. I'm like, thank you for your service. Let me see what's going on in the world, why you just got an emergency order. You're called in on Sunday to put together some missiles. That's something that intrigues me. I like knowing that information.
And the other thing, in terms of imagining a European drone army, whether it's aerial or ground, people like to joke, Europe's the world's museum, or if it wasn't for us, we'd all be speaking German and all this sort of derogatory things about Europe. But I invite you to look at German cars and their relative quality. I invite you to look at Airbus airplanes and their relative quality. So I think that it is foolish to suggest that the 450 million people that is larger than the United States that occupy the European continent do not have the ability or the resources or the engineering or technical expertise or ambition to make extremely high performance machines. Mm-hmm. Whether it's look at the Italian cars, look at the German. I mean, you don't need a lot of evidence. There's no shortage of brilliant European engineering and materials processing, and I'm sure that they will make a formidable drone army in the sky and on the ground. And I think we'll probably see it in that.
It's also entirely ahistoric to forget all of European history after the Second World War. This is a continent that's soaked in blood. Its borders are settled by warfare of the most expansive kind forever and ever.
Which then makes me
wake
wonder
wake up at the Renaissance and think that Europe is that even is to misunderstand who these people are completely.
I wonder if it does trigger, going back to your sort of original point at the beginning of this discussion, Ilya, a United States of Europe as a way to ensure against intra-European, that this is the final catalyst, not to just go to an economic union, but a political union.
Yes.
In order to consolidate power relative to China, Russia, and the United States, who all three are now adversaries.
I think
with the United States, you have Russia in Ukraine, but you also have the United States threatening to invade Denmark as we speak.
This is, by the way, a plot to one of the Call of Duty games, by the way. Just to put this out there, there's a Call of Duty game where the EU disintegrates into the Common Defense Pact to deal with a Chinese and American aggressor. So, can we get a better script? This story sucks. We've seen this before. At least I've played it before.
I think you should buy European stocks. I think there's going to be a big boom here for the next 5 years.
Okay, so actually,
this is the way the European Union has always worked.
Will they build their army
need a forcing
first?
function.
Will we get a European army first, or will we get Grand Theft Auto 6 first? That's a question for the chat. I think that's a legitimate question to ask. Still waiting for Grand Theft Auto 6.
Ilya's trying to make a critical point on the future of the world. Okay, please.
I mean, I think the fact that we're likelier to get a European army than Grand Theft Auto 6 makes the point.
It's got to be a poly market for that.
I think that's the point. They're in a hurry. And whatever sacred cows they have to slaughter, this is the kind of thing that gets them slaughtering sacred cows.
Yeah.
This is the way that the European Union has always worked. They need a crisis.
And it's like anybody who sort of start to drift into sort of wishful thinking in Brussels, you get the signal leak from 2 days ago with the American vice president saying, fuck Europe. Like the Germans are serious. Trump may not be a serious person, but the Germans are serious people.
When the Germans and the French and the UK of all people hold hands and say we're going to have joint nuclear deterrence and we're going to spend money together and basically say we are going to replace the American umbrella with something of our own, that these three people, just knowing the history, that these three people are joining together, this is sort of the European project's next big phase. This is debt mutualization and political union and all of it.
Right now, Europe is basically the American Republic after the Revolution, but before the Constitution. It's like the Articles of Confederation arrangement. By the way, the poly market sees that Grand Theft Auto is in fact more likely to be released this year than seeing EU troops fighting in Ukraine in 2025. Something to consider. Maybe that's a pair trade to work on in the future, because I could easily see GTA being not released this year.
Let's put it on the screener.
I mean, the other thing that I'll add to your point, Ilya, just in terms of the strength of the European alliance, you see, if your big three, even with Brexit, whatever, with England, France, and Germany, who are all sort of natural siblings / adversaries until it really matters, which obviously now it does. But also you have the most stable government in Italy since World War II, and an Italian economy that's the strongest it's been in decades. And so even the sort of lesser players, of which Italy's obviously a more diminished political force than Germany or France or England, is still at its strongest relatively in terms of joining in. And then Poland can't be underestimated because it is so incentivized. The motivation level in Poland is the highest of everybody in terms of doing this.
Poland has the highest motivation level because they've been the doorstep for.
They're at the door.
Napoleon, right? Like you got to get to Russia, you got to go through Poland, right? For Hitler, they've been the doorstep for European conquest and invasion for the past.
And they're always the most hawkish. I mean, they're the ones. They're like they'll go to war with Russia with your army any day of the week.
Well, I mean, Lithuania, Latvia, and Estonia have been basically running drills for a partisan resistance to a Russian invasion forever and ever because they've seen what it is. They see themselves as Western European. They're not going back. And there's very clearly a different vibe here.
I mean, the sweet spot for risk, to be clear, is if they can build out the capacity and they don't ever have to fire a shot. Right? No one here is rooting for Europe to raise an army to go to war. Just keeping an eye on
it's just the buy-in.
There's no bloodlust.
It's like if you want to sit at the big boy table, you need the army for the buy-in. I mean, that's basically what Trump.
You need a standing army of 1 million soldiers, and you need to have nuclear weapons. And unless you have those,
and the argument I'm with them, as you point at the U.S. president, no longer works, or maybe doesn't.
No, for sure it doesn't.
Certainly, well, for the next 3 years, it doesn't.
Fair.
And then we'll see.
So for the second half of the week, what trades are we working with heading into tomorrow? Dylan, you've been speaking fondly of apparently a trade that I put in your ear yesterday, Amazon. I assume that you're going to be sticking long with your Amazon call spread here?
Sure.
Do you have any position adjustments that you're looking to make tomorrow, or are you content with where things stood at the end of the day today?
No, I'm content. I'm more sort of trying to figure a way to. Now I'm all hopped up on trying to figure out a European situation, but I just think the only way to do it is with it's not a trade. Again, the euro would be the only tradable slice of that pie. Otherwise, it just seems like something that I want to own.
Here's the European trade for you, Dylan. If I owned a footwear company, these soldiers are going to need a lot of boots.
You want me to switch over to boots from fancy sneakers to the problem is drones don't need boots.
But the drone operators will. Right? Unless we're doing all autonomous.
They may even need sneakers for long hours at the desk.
Yeah, right.
I think the sneaker business is going to benefit more from all the stinking rich defense contractors looking to spend money on luxury goods and go to Paris and buy champagne bottles.
A bunch of money is about to start changing hands in Europe.
That's my point.
Ilya, tomorrow, position adjustments. You've added some TLT exposure, looking to, as a way to play the recession trade without necessarily standing in front of a stock market bounce. What else is on your to-do list, your watch list?
I'm thinking about what's going on with the yen here. It seems to be trying to make some kind of attempt at a turn lower. Like maybe the dominant move is breaking down. I don't think this is a lasting thing, but this looks much more convincing of a dollar strength story than does the euro or the pound or the Aussie or the Canadian dollar. So I'm watching this closely now and thinking maybe, just maybe, I want to sell a little yen. I'm not prepared to do it, and if I do it, I'm going to be doing it in spot because I am not going to step into a 6J full-size contract thing. I don't have that kind of conviction, nor do I think that my kind of risk management approach where I nibble until it starts to work and then I really scale in. I don't think that works with a contract that size, or you need a lot more capital. And so I'm going to do it through spot. being long yen since as part of my kind of dollar short basket has been very lucrative. I got out earlier this week on Monday. I want to be again long yen. I think the longer term idea is there, but it looks like this one might have a bigger reversal. It's trying to make a move.
I'm still leaning some long delta in ES. I'm leaning long delta in the yen right now. Gold, silver, notes, bonds. I still have some of those various AI phase 2 names on. One of them is actually just kind of meandering around. I really would like a break above 35 here in EPD. I'd also like to see Exelon continue its march forward. It's been a brutal 2 or 3 days here, but it's long the 42, short the 47 call spread. So still working, but not working as well as it once was. I don't see a reason to adjust positions right now, particularly as we head into the middle of the week. Maybe durable goods tells us something tomorrow that we already know, that the economy is heading towards a stagflationary light type of mindset, lower growth, higher inflation, weaker labor, but not actual stagflation. I find this market today to be just absolutely dreadful. From futures power hour to now, Ilya, the market is up a net 4 whole points in ES from when I started that at 1 Eastern time. So needless to say, I think we can call it quits here for now. Overtime is at a time for this Tuesday. Yeah. We'll give everyone a little break. Get off early. Go. It's nice out. We have the time change. It's sunny here in New York. And Dylan can go to bed.
Oh, it's beautiful here in San Francisco.
Actually, Dylan can have an espresso, right? We're not going to have a cappuccino this late in the day. I digress. I'm meandering.
Buy that TLT. I think the most intelligent thing said today was buy that TLT at the beginning and paint your bathroom off-white. I think those are the 2 real takeaways today.
And with that, overtime is now out of time. We'll be back tomorrow, same time, same place, every Monday through Thursday, right after last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. Good luck trading. Be sure to stick around, though. After this, Tasty at Night, starting with Macro Money, Ilya Spivak. I'm on later with Victor Jones for the Price of Truth. So strap in. More coming at you soon.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tastytrade. Make your move. Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number 1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tastytrade. Make your move.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100 shares of long or short stock.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
I got Joe in Houston. What's up?
Just want to call in and say I really appreciate everything. I started trading and learning from you guys about 6 years ago. You know, it was you guys' work and the platform that got someone like me that didn't really know anything about the market capable of really outperforming the market now for, 5 out of the last 6 years. And so I really appreciate you guys. I can't think of another company where I can pick up the phone and call the CEO, the trade desk, and reach somebody as quickly as I can there. So just really appreciate everything and what you're doing for guys like me out here. What you're doing is really spectacular. So really appreciate it.
Thank you, my friend.
I really appreciate it.
You made my weekend, man.
If you missed the live show, here's our cherry on top weekly recap.
I got my Ted Lasso.
You actually have pants on.
Yeah, of course. I'm in school.
Huh, got it.
You're flexible.
It's cool.
Yeah. Oh, nice. You are pretty flexible. Let's see you get that leg up again.
Oh yeah, he's really. Right now, my other leg is cramping.
I believe that to be true.
We just ripped higher up to 50 points, and I just thought we would stay there, but
the thing the market does best is it keeps you very humble.
You get paid a lot for being right, and you lose a lot for being wrong.
So give me, a couple hours, and I will give you everything that you need to start trading options. See you soon.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Stocks meander. No progress today on the rebound after last week's encouragement from the Federal Reserve. And we're going to take our focus here away from equities until they decide what it is that they think they're doing and focus on the other big market that's on the move around these on again, off again recession fears that have been pummeling the markets since the end of February, and look at currencies, because one of the things that has been a standby of all of this consternation has been a sinking U.S. dollar. I'm going to take a look at what that means, why it has happened this way and see if we can't figure out if, as stocks rebound, the dollar is also due for a comeback. What that might mean and what the trade could look like if it is or it isn't. So let's begin here with a conversation first and foremost about how we arrived at this interesting juncture. So we have here U.S. inflation expectations and monetary policy expectations, as well as their reflection in asset prices. At the top, you have U.S. break-even inflation, the 5-year and the 10-year rate. Very interestingly here, first, what you see is that they've both been declining recently. And you notice that this has been going on at the same time that you've had a pullback in both front and long end yields. So down here, you have the 10-year, you have the 2-year, yields lower there. And of course, as this is occurring, you're also seeing that the US dollar, this is the dollar index here in the green, it's been pulling back at the same time. And of course, this is the same exact story that has given us the stock sell-off, the 4 weeks of blistering selling in equity markets since about the middle of February into the middle of March. We finally stalled on that sell-off and broke the 4-week trajectory there last week, but only by a hair. We ultimately ended up stalling, and now this week we're trying to maybe turn that stall into some kind of a rebound. But the story here falls over exactly the same time frame and is occurring for the same reasons. And that, of course, is what we have summarized here with the Atlanta Fed's GDP Now model. Now, it's probably not realistic that in the first quarter of this year, the U.S. economy is going to contract at an annualized rate of 2%. That's probably too extreme. In fact, the PMI numbers that we just saw out of S&P Global guesstimate that instead we're going to get a slowdown to something on the order of 1.5%. So somewhere nearby this range of major forecasts from big financial institutions. But the key insight in this Atlanta Fed GDP Now model isn't so much its level. There's still quite a long time for it to even out until the first quarter GDP numbers are actually due to come out. There's a lot more inputs into this data. Instead, what this tells us is the tone of the inputs that have been coming into this model since February. And what we find is very clearly the tone has been very negative. So what this model does is it takes incoming economic information and spits out what it thinks the Q1 GDP number would be if no more data came in on any given update. And this is the data here as of the latest update. That update was made on March the 18th. So we're talking about a week ago. Is the latest. We're going to get the next update that's coming up to this tomorrow. It'll probably edge up a little bit more and reflect the tone of the data getting a little bit less awful just in the past week. But nevertheless, you very clearly get a sense that U.S. economic news flow would have had to be relatively awful for the better part of a month, going from about here to about here, in order to produce a model that gives you this level of a drop-off. And so really this is more a lens on just where the market's recession fears are coming from. As incremental pieces of data come out, this is what the model exhibits. And what that tells you is the data itself has been terrible. And that, not surprisingly, gives you weaker stocks and, of course, less inflationary pressure. Of course, more expectation for Fed stimulus and so lower yields. And with that, a loss of the dollar's yield advantage to some marginal extent that then moved the dollar lower relative to other currencies. Now, we saw last week, and this is sort of what put the floor under stocks here near term, is the Fed came out and gave us their updated summary of economic projections, and they did dutifully revise growth expectations lower, lower for this year, lower for next year. But they kept the path of interest rates unchanged, essentially saying we don't know how sticky of a growth scare this is. We don't know to what extent it's warranted yet. So we're going to wait to see more hard, quote unquote, data to get a clearer read. So the Fed seemingly at once commiserated with markets about these concerns, responded by showing that they're paying attention, that they're prepared to act if necessary, but that they don't see urgency to pull the trigger. And as if on cue, at the start of this week, we saw U.S. manufacturing and composite and service sector PMIs updated, and they came in better than expected. In particular, the service sector numbers that were the source of such consternation in January and February, because, of course, you can plainly see here with the naked eye, the composite index is tracking the service line, and the manufacturing line is kind of on its own, which tells you just how important services are for the overall economy. The economy is driven primarily by services. So when services saw this massive decline here, and the composite index went with it, that's really what spooked markets and started to get them thinking about, whoa, maybe we're looking at a recession. In these March numbers, there's been a rebound, and it's not the kind of rebound that puts recession fears to bed. Certainly, there's been a level shift from growth up here to growth over here. But these numbers came in overall better, all three of them, than the markets thought. Faster service sector growth, as ever, these numbers are centered around 50, where that's neutral. Under 50 is contraction. Above 50 is growth. And the further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So faster growth for services, faster growth for the overall economic activity, and weaker performance than expected from manufacturing. In fact, it's now narrowly in contraction mode again. But as we said, services is the much more important piece here for the overall story. In fact, all of the U.S. outperformance last year happened with very anemic conditions in manufacturing. So that seemingly has convinced the markets that the Fed was right, that there is no emergency, that at least for now it's okay to wait and see. And so the markets moved, obviously, through this recession scare. They adjusted policy expectations to something more dovish. This was the beginning of the year where maybe we were looking at something like 50 basis points in rate cuts. And this is where we are now, basically in line with the Fed's expectation of about 4. Indeed, the markets are a little bit more urgent. They have a bias to 2 erring on 3 cuts this year and 1 erring on 2 next year, whereas the Fed is, of course, at exactly 50-50. So 50 basis points from 4.4 to 3.9 this year, from 3.9 to 3.4, another 50 basis points for next year. But when you look at this in broad terms and you sort of allow for market volatility and speculative fuzz, you are basically looking at alignment. And so the question then becomes, well, what is the impetus for speculation then on a still weaker dollar? Are we perhaps done with making the adjustment, at least for now, that has given us this dollar sell-off? And is this maybe the time to look to bottom fish a bit? Now, if we look at the way that the dollar has performed since the beginning of the year against the major currencies, we can see the euro and the yen have done the best. In fact, the euro at one point was the clear outperformer. It was up almost 7% since the beginning of the year as of last week. And that's, of course, around speculation that there's going to be a ton more European defense spending to make up for what is now looked at as a less reliable American security umbrella. We've, of course, seen that become something that has really taken on a lot of urgency in Europe. Germany has suspended its debt break for defense spending even before the new chancellor, Friedrich Merz, takes office and the new Bundestag sits. And that's largely because the new Bundestag probably has some veto votes from hard right and left minority parties. And so there was an urgency to get this done before the new government is even installed. And so the ruling coalition of the SPD and CDU-CSU, center-right, center-left, managed to cajole the Green Party into getting this done so that this defense build-out can happen faster. That, of course, speaks to a lot more spending in Europe, probably a lot more inflation. The bonds have certainly cratered and yields have gone up. And not surprisingly, that at a time when U.S. yields have come down, as we've just seen, has shifted the balance for the euro significantly. And, of course, that has powered its outperformance. Lagging behind the bunch has been the Australian dollar. It's much more anchored to global growth than the rest of these top four currencies. And, of course, we chose these four because these are the top four counterparts by turnover for the dollar, according to the latest numbers from the Bank of International Settlements. These four overwhelmingly account for almost all dollar-based volume. Everything else is relatively small. And so as you look at all of this, then you get a sense that for a currency like the Australian dollar, the risk-off tone has really weighed, and it's increased against the dollar, but not by a whole lot, less than 2%. It was up as much as 3%, but has since come in, and of course that has not compared favorably with the rest. The yen has done exceedingly well, as it tends to do when U.S. yields fall. And the British pound has interestingly lagged. And this is perhaps where the opportunity arises. So we know that Europe is looking at this defense build-out. We also know that the UK is very much a part of this conversation. In fact, there is increasingly a discussion about how France and the UK together might form a peacekeeping mission in Ukraine, about how they might become together the new nuclear deterrent in Europe to essentially have a common second option for the region that isn't the U.S. And with that, you also have a big fiscal spending story. Moreover, if you look at what has happened now with policy expectations by year end, we can see that with this dovish adjustment in U.S. expectations, that's the blue line here, and what these numbers here reflect is year-end interest rates that are priced into the relevant futures markets, Fed funds futures for the U.S., ESTR for Europe, SONIA for the UK, so on. The bank bill of futures in Australia. If you look at where we are now, Japan, of course, has the lowest interest rates of the bunch. That's to be expected. The European Central Bank is next, and you can see their expectations have been drifting higher around this build-out idea. The key thing here in the relationship between the US and the UK, though, now looks like the dovish adjustment in the US puts the year-end rate below that of the UK. The UK is now expected to have the highest interest rates of the bunch here by year-end. And that makes this underperformance eye-catching, suggesting that maybe there's room for the pound to have an outsized move higher against the dollar that it hasn't played out yet. And we have a catalyst here just on the menu in the coming hours by way of UK CPI data. Now, the expectation is we're going to get a little bit more disinflation, but not dramatically so. Down to 2.9% year on year for the headline, down to 3.6% year on year for core. For core in particular, we can see we're still very much stuck in the range that these values have held since 2024, and we're not really going anywhere. In fact, if you look at the internals of the previous report, what you see is this very stubborn, sticky inflation in areas of the spectrum here that really you would think would be much more amenable to a decline in discretionary spending around slower economic activity in the UK until recently. And yet, you still have recreation and hospitality adding essentially a full percentage point to headline inflation. Cut those by half, and you would be much closer to the target. Cut them down to something more historically normal, and you might well be pretty much on the Bank of England target. But nevertheless, here we are, and the stickiness here seemingly resistant, even as, if we look at the latest UK PMIs, going all the way back to the middle of last year, the economy has been slowing across services and manufacturing until this latest upswing here in March. So ostensibly, you have a situation here where the slowdown in the economy should have shifted spending away from discretionary and toward more core spending as the economy creaks along and consumers become more defensive, but that has clearly not occurred, implying that maybe something is sticky here, perhaps because of inflexibility in the labor market. And with that, you have something of a bind on the BOE's hands to cut rates. If we look at the expectations currently, we're sitting at maybe 2 cuts for this year, but that has been diluted some, only 39 basis points out of 50 actually baked in here, which if you take a look at then the likelihood of that next cut, you're really only looking at a situation where you have just 14 basis points toward that second cut that's priced in. It's narrowly better than even odds that you get 2 cuts, 56%, but it has significantly diminished. And next year, you're looking at essentially standstill. So the story here is one of a Bank of England that is not in a hurry and where things have been relatively stable around the forecast for a while. Moreover, as we just saw in the PMIs, March marked something of a perking up of the service sector. And so even though you might have a little bit of a downswing here on inflation, the likelihood that this is going to move the Bank of England to move any faster seems low. In fact, we just had a policy announcement from them last week, and they were a little bit more hawkish than expected. The number of people voting for a rate cut on the MPC, the 9-member committee that decides a policy, that minority ended up being smaller than expected. It shrank to just one vote arguing for a cut at this point. And that's certainly not something that seems amenable to one small downtick on inflation that doesn't really take the trend in the right direction by itself. All of which is to say, we might have a situation here where what this CPI report does is reinforces the idea that the Bank of England is going to sit on its hands for a while. And if these dynamics here, this starting of normalization a little bit in the service sector, begins to show up as demand pull inflation, well, then maybe the numbers actually have scope to surprise on the upside. And in that case, this underperformance from the British pound relative to the dollar is going to start to look glaring. Now, the levels readily present themselves. We can see here we're consolidating just under this former support become resistance cluster where we've held so many times before in the 130 to about 130.50 area. Now, negative RSI divergence here suggests that as we came into this high, momentum was ebbing, and indeed we've stalled. But what we haven't done is lost grip on this support above the 128 area. If the CPI number gets us through 130 and gets us somewhere over here, we then have, seemingly, an open lane north of 132, and then, of course, above that, an open lane north of 134, but that's the next consideration. But the up move here is holding, unlike perhaps what's going on in the yen, unlike perhaps the greater damage that the euro has sustained in the near term. Its pullback has been more sizable. So what we could have here is a coiling up before the next leg higher, and the UK CPI numbers may well give us that catalyst. That is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise coming back in just 30 minutes time for the Price of Truth with Victor Jones. Stick around for that. I'm also on with Chris for Futures Power Hour Mondays and Fridays, on with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.
Of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Looking for a better broker and a bonus? Sweet. Get up to $4,000 when you open and fund a Tasty Trade account. Plus, smart tech and a broker who's got your back at Tasty Trade. Make your move, genius. Tasty Trade.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
How much does it cost you guys to do simultaneous hair flips?
Years of practice.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Just for a minute, let's forget about your favorite stocks. Just for 1 second, let's leave specific strategies on the shelf. Let's talk about what really matters. Your portfolio. How do you build it? What should you target? How do you manage it day to day? The answers to these questions and more are inside our newest crash course. So I'll see you there.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
What is going on, everybody, and welcome back to the segment. Today's Tuesday. We got some things to talk about in the market, but we also have a different type of segment prepared for us today. Before we get into that, Gus, how are we doing, brother?
Doing well, always doing well. Market's turned around a little bit, so feeling good. I'm still long delta, and the positions are printing. I always say that there's some days that make you feel like Warren Buffett, and some days that make you feel like you should never trade again. And this is one of the former days. This has been a good day.
No, it's funny you mentioned that because it's like you can have experience in the market, and there's some days where you just feel like a straight amateur. Like this is something you just picked up, so I completely hear you on that one. Good day today, rally to the upside, some long delta. Any positions kind of stand out from the rest over there today?
Well, actually, the position I've been looking at with the most scrutiny is Walmart. I have just Walmart shares, and this is like the only shares that I just didn't have bad timing on or that haven't recovered, I guess, might be more apt. Gave a little bit back today, so that's burning a bit of a hole in my pocket. But yeah, outside of that, I suppose Tesla is the big story of the day. They're up 10% in the last 2 days, and I think it was like 2.5% into close today. So yeah, quite the rally out of them. Still a long way to go, but it has begun. And once again, I apologize to my mother for telling you Tesla was not a buy 2 weeks ago. My bad.
Oh, that's funny. Tesla was kind of the talk of the town. We'll do a quick tour to market, and then we'll get into our segment that we have prepared for today. But I ended up taking Tesla off. We'll go to Tesla real quick. I ended up taking it off earlier today, Gus, and I asked myself, I was like, this could keep rallying, but I was up about 60% of the capital received on the trade. So I was like, you know what? let me trade the data and not my emotions or feelings. So I was like, you know what, I'll just go ahead and take it off. And then you reminded me that Tesla's still ripping to the upside. So I appreciate that. And yeah, we concluded with Tesla. But other than that, got out of the hole with Meta. Gus, I know that one was almost near a max loss on that one. And now we're sitting up break even. So hopefully this rally continues. QQQ kind of break even on that up a little bit. USO, shout out to Liz and Jenny, Gus. I know they pioneered the Zebra, the zero extrinsic back ratio. If you're not familiar, it's a synthetic stock-like position. You put on a long 100 deltas, and it's a 1-for-1. So the underlying moves up $1, you make $100. The underlying goes down $1, you lose $100. That's finally coming through a little bit today. But I got to say, Gus, I meant to take this one off way before. The markets are so wide, I didn't actually get filled. So hopefully the market gaps up or oil keeps rallying. Oil's not one that I typically trade on the regular, but that's what's new in the portfolio. Got a lot of positions to manage by the end of the week. 23 days till expiration. So 2 more days. Got to figure some things out for the rest of these. But that's all we got. That's all we got. Not as much long delta, but we've got a few positions that could capitalize on the move today.
Yeah, I would float also. I picked up a long position on Chewy, just weeklies. They have earnings tomorrow. I actually don't know if it's before or after close. I don't care because I'm already in, and I think that they're going to be good. But yeah, earnings go off tomorrow. I picked up 2 bull call spreads, sold the 31, bought the 30. So we will see what happens with that. And there has been a few times today and yesterday, in fact, where since I've added this position, where all of a sudden my 31 call only the premium will get crazy juiced, and it'll look like this is a massive loss for like 10 minutes at a time, and then it fixes itself. So whoever's messing with my Chewy 31 calls, stop it. Trade 30.5s instead. I don't care. Just not mine. Stay away from it.
Leave the calls alone. Leave the calls alone. No, I love it. Chewy. If I'm not mistaken, I think Chewy, I don't know the developments their website has gone through, but I believe Chewy, if I'm not mistaken, originally built their website off of Shopify. So sometimes it is kind of crazy to see some of these new tools that have been built for entrepreneurs and people building businesses to be trading on the NASDAQ on as a publicly traded company. So it's kind of crazy to see how far some of these companies really take things. But are you a cat or dog person?
Yeah, I like cats. I'm in the market for a couple of cats right now. Actually, I just moved up, and I have 2 weekends of travel. The first one being this previous weekend, and I'm headed back to Texas for a wedding this coming weekend. But after all this travel is settled, I'm gonna be cat shopping. Not shopping. I'm gonna be shopping in the adoption center. But I'm looking for 2. So if anybody in the greater Chicago area has extra kittens, get at me. I'm your guy.
I think Julia might have a few. She might not even notice if you borrow them.
That's true. Yeah, I think I could. I think Julia could afford to give me 2 cats.
Yeah. No, but Chewy, Gus, shout out. He's about to be a parent, but we'll see how Chewy plays out for the rest of the time being. What's going on, Lone? What's going on, chat? I know we do have a segment though, Gus. What's new? What do we got here?
That we do. Talking Warren Buffett's 5 pillars of wealth building here. This is an exciting one. We're just gonna 5 simple rules. We're talking about good old Mr. Buffett over here in the chat. And boy, does he have no shortage of advice. And I just wanted to dive in and touch on a few of these points.
No, definitely. Warren Buffett, I would say probably one of the biggest brands within the investor space in terms of personal brand. I mean, he's extremely popular. Shout out to it was like the documentary style. You've seen it. I forget what it was called, but when he's driving through the drive-through, he gets the same thing at McDonald's. What was that again? I forget.
I don't know what it's called either. I know that I've seen it. You saying McDonald's made me want to say the founder right there for a moment, but I caught myself.
I hear that was really good. I've been meaning to check that out. I really love the movies with like what was it called? The one with Facebook. I forget what the social network.
Yeah,
those type of. Is that what it is? A social network? Yeah. Someone mentioned the founders again the other day. I've been meaning to check it out. But 5 simple rules built on the advice of the greatest investors of all time, and they're easier to implement than you think. But are they? Let's get into it. Never lose money.
Easy.
Never lose money.
It's literally that easy.
Easy. Just don't do it.
End the stream.
We're done. Just don't do it. The best risk management advice you could ever have. But rule number 1, never lose money. Rule number 2, never forget rule number 1. And the rule: only take calculated risks on investments that you have researched thoroughly and believe in the long term. So diving into investments with a lack of knowledge, that's always been a thing, right? Would you say it's a little bit more popular with social media? I know even when I was first getting into the trading space, I was easily influenced by other people's thoughts, opinions, underlyings that they brought up, because I was like, such a new space. It was a little comfortable to lean on somebody's thoughts or opinions that seem like they have more experience than you, especially in the land of the market. So I know I can speak from that point of view, but never lose money. What does this mean to you, Gus? Rule number 1.
Yeah, I mean, I think that it just serves to emphasize how important risk management is, and this is something that Warren Buffett certainly lives by every day, and it's what they do with Berkshire Hathaway.
Yeah.
We all know right now, late 2024, Berkshire Hathaway suddenly hoards $300 billion in cash, and everybody says, "What's going on?" Suddenly, early 2025, we take this little dip, and Warren Buffett's laughing to the bank while everybody else is panic selling and getting out. So yeah, I think that you make a great point too, that, and this is something we'll get into a little bit more with our third point that's coming up, but in the age of social media, there are so many people who claim to be good at investing, and there's a lot of discourse on the internet, and also the activation energy to place a investment order is so much lower. You just whip out your phone and do it, and your money's in it. Just 20, 30 years ago, you would have had to actually pick up the phone, make a call, maybe do a little bit of legwork to find what the current price even is. And now, yeah, it's as easy as you see one post on Twitter and you can go impulse buy that stock if you so choose. So I think that it's just very important to place emphasis on, only taking calculated risk. And it's also important to emphasize that this rule does not mean Warren Buffett has never lost a dime. He takes calculated risks. He sometimes loses money in the short term, but he very rarely loses it in the long term. And it's because of how much legwork goes into every trade that he makes.
Yeah, that's a really good point that you bring up. I know another what I like? Never lose money. I like that. But you know what I also like, Gus, is never lose money that you didn't take in account. Like, for example, it's like we can calculate our risks on trade, but it's like, should we be losing more? Like, the only thing we can really control in the market is how much we lose. We can't really, control how much we're making or when we're making it. Like, really the only thing we have any type of control over is how much we lose. So I'm vibing with rule number 1, Gus.
Yeah, I agree. And it's important to remember that there's no investment that you ever have to make. There's too many good ones. But that brings us right into rule number 2 as we talk about stupid purchases, and that is 24-hour rule for purchases. The quote from Buffett here is, "If you buy things you do not need, soon you will have to sell things that you do need." This one really strikes home. Before making any non-essential purchase, you should wait 24 hours. And if you still want it after a day, you can consider buying it. Prevents impulse spending, keeps money working for you. I'm sure that everybody in the chat could cite one moment in their life that they impulse bought a bad purchase and then got stuck holding that bag, perhaps a literal bag in some cases. My personal example is when I was 10 years old, I got some birthday money, and Errol's already made fun of me for this story off air, by the way. When I was 10 years old, I got some birthday money, and I wanted to spend it, so my mom took me to the mall. And for some reason, I got in my head that I really wanted a watch, and so I found a nice blue watch, and it was actually, I was shocked to come across this Pugot looking at pictures of blue watches on Google, because it was clearly supposed to be a ripoff of this very watch, the one that I bought. Right. And it was something like $50. I don't know, nothing crazy. But pretty much instantly, like by the time we were in the car, I felt like that was a terrible purchase. It started to weigh on me. And pretty much by the time we were home from that drive, I was like, I wish I hadn't bought this. Unfortunately, my mom wanted to teach me a lesson about buyer's remorse. So I got a short educational lecture, and then she let me go return it at the mall the next day, which I think was the right way to handle it. It stuck with me all this time. But had I, even in my 10-year-old naivety, slept one night on that purchase, I probably wouldn't have made it. And that's something that's prevalent in a lot of purchases and can also happen in stock purchases. This does not just apply to big ticket items. It also applies to stocks. If you're about to load, say, a considerable portion of your portfolio or your retirement or whatever it may be into a position, sleep on it. Make sure that you're still feeling good about it the next day. And I promise, if you get it $2 a share more expensive than it was yesterday, it's not going to be the end of the world if it's a strong buy.
I really like that. Have you noticed within specific products or items you naturally have more of a buyer's remorse towards? Like, I know me, for example, I love shoes, but I've noticed just growing up, shoes specifically, like I really have to like them, and I'm more likely to have that type of feeling that you were breaking down when it comes to that specifically. I don't know what it is. I don't know why, but That's what it comes down to for me. So waiting 24 hours typically doesn't change how I feel on some of those events in the past.
Well, hey, if it doesn't change after 24 hours, you're allowed to buy it. That's what Mr. Buffett says.
We're good to go. Yeah, we're good to go. We're good to go. No, I love that one. And again, I think actually, let's go back quickly. This goes down to this relates heavily to the market because impulsively buying and selling things. I know sometimes if you're just sitting there, you could impulsively get into certain positions. Maybe you see something that looks attractive. Maybe you didn't even calculate your risk before you get into the trade, and now you're impulsively buying an asset in the market, and then now you're trying to have to figure out how you're going to manage your risk on that. So putting a lot of thought into the things that you're purchasing, most definitely.
Yeah, and I would
shout out to Warren Buffett.
I would build on that as well, that you shouldn't impulse try to get out of things, or oh man, I impulse bought, now I'm long delta, I'm going to impulse sell, I'm going to impulse try to get more delta neutral. Relax. Take a breather. Unless your position expires tomorrow, you can probably wait that long, and there will be better opportunities that present themselves.
So I've fat fingered trades before, right? Like I've bought things I meant to sell. I've sold things I meant to buy in the market. So next time that happens, Gus, I'm gonna sit on it 24 hours. And like Gus said, 24 hours. I'm gonna wait till tomorrow, see if I still want to be in this position, and we'll come to a conclusion.
Yeah, nobody tweet at me and tell me your position expired overnight. That's my asterisk. You gotta, if it expires tomorrow, you do gotta figure out something right
now. Rule number 3: punch card investing. If you had a punch card with only 20 investment slots for your entire life, you'd think a lot harder before making a decision. The rule: treat investments like permanent decisions. Only invest in things you truly understand and believe in. You know what this kind of reminds me of? It kind of reminds me of the PDET rule a little bit. It just kind of reminds me, like, I know we have a lot of other ways that we trade and other products to trade where we don't have to worry about that. But when you're limited to a certain amount of intraday trades, it makes you a lot more picky about what you're getting into, because you only have 3 for a rolling 5-day period. So that's kind of what my mind goes to when I think of this. But 20 investments. It sounds like a lot of investments, Gus. I don't know what you think about this right off the bat, but maybe once we're 30, 40, 50, 60, we'll be like, that's not a lot. But 20 investments sounds like a lot, whether it's a stock you're purchasing or investing in a business, a private equity, whatever it might be. But 20 investment slots, it's definitely going to make you more picky on where you're putting your money. What are your thoughts on it, Gus?
Yeah, this one strongly ties back into our first rule, I think, of never lose money and about taking calculated risks. I know that what comes to mind when I think about this is Snowflake. I bought Snowflake at IPO for no reason. I was younger. I was naive. I kind of just started trading. There was all this social media discourse about Snowflake and how it was going to go ballistic after the IPO. And I did not one iota of research. I couldn't tell you to this day what exactly Snowflake does, cloud computing, I think. But I bought an irresponsible amount of Snowflake, and then it went up maybe IPO day, maybe for 2 or 3 days, and then immediately turned to the downside. I wound up exiting that position for about a 40% loss. And had I only had 20 investment slots for my entire life, that is most definitely not a trade that I would have made. So I think that it comes down to that, but also I think that there's a delicate balance here of giving a little bit of scrutiny towards every trade, but also not getting so caught up in this 20 investment sort of rule, because there are also plenty of people who would have talked themselves out of Apple or Tesla or Nvidia at IPO based on these rules as well. So there is a healthy amount of risk to take, but the core point here is that you should be very confident in everything that you're buying and be ready to hold it for a long time should you need to.
That's a really good point. I was thinking about it in terms of, portfolio management too. And I was just thinking, that crossed my mind was as well. I was just thinking, if the probability, if you've done the research, you've calculated the risk, and the probabilities are in your favor, it's like, what are we it's like, how do we become a little bit more picky with those things? That's just kind of what my mind goes to, because we can't really tell, what the outcome of a single trade is. I know we're talking about it in trading terms now, but the outcome of a single particular trade is going to be. And it's like, how do we refrain from having that bias? Now, like let's say we have to be very picky with 20 investments and we're selling, let's say, some option strategies on it. If it gives me the odds, the calculated risk, the probabilities in my favor, now I just think like, how would we manage that? How do we choose from that 20 if probabilities at the end of the day is what we focus on? But that's just another thing that comes to mind before we wrap on this slide, Gus. But I see we got Warren Buffett here, 20 investment decisions, and we got 20 slots for that. So we'll move on to the next one.
Yeah, that's your Buffett punch card there. Everybody, you can screenshot
Buffett punch card
if you want.
It looks like Monopoly. That's what I was thinking.
I googled Buffett punch card and I was shocked by the options. If you guys open another tab, Google that real quick. There's like 20 of them. It's very funny. Anyway, yeah, next slide here. Be greedy about time, not just money. Warren Buffett, very famous quote of his, I can buy anything I want, but I can't buy time. And that's so true. Wealth isn't about money. It's about control over your time. You got to focus on building passive income, automating finances so that you can spend more time doing what you love. That's what will ultimately make you wealthy. If you have all of the money in the world, but never an hour to spend it or anybody to share it with, you're going to wind up pretty unfulfilled, no matter how much money you continue to pour into the bank account. And I understand that I'm young, but this is not lost on me. In fact, I've already gone through processes reflecting this in my life. My freshman year of college, I remember specifically, I was so dedicated to spending every single waking moment that I wasn't in class making money, and I drove for DoorDash. I was trading every moment of the day, including in class. I got some strange looks from people behind me when I had my 6 charts pulled up at a time. Pressure washed, ran a little drop shipping operation. I continued to work my high school job when I was on breaks from school. And continually, I was turning down my friends as they went to party or, go on little vacations or go cliff jumping or whatever it may be because I had to work and I was so focused on the grind. And at a point, I came to realize that if you're always thinking about how you can make your life as good as possible 5 years from now, I'm still going to be doing the same thing 5 years down the line when I'm supposed to be able to reap these rewards. And so there's a delicate balance there. Obviously, you do have to put your nose to the grindstone and do things sometimes, but it's important to not get lost in the sauce to the extent that you forget to enjoy the times that you've created.
No, absolutely, 100%. And I think it's like a fine line too, because just like you were saying, I think it's important to be proactive a little bit earlier at the same time, but finding that balance, which can kind of be a skill that you develop over time too, as you have more experience doing this, that, and the other.
Work hard, play hard. It holds up, right, truly.
It definitely does. What was your first job, Gus?
My first job, I had it for 4 years, actually. I worked at a UPS store. I was a sales clerk and eventually assistant manager. But yeah, I worked there for 4 years from 2 months after I turned 16, like as soon as I was allowed to, pretty much all the way through the end of my freshman year. I would have almost been 21, I think, when I finally broke things off.
Yeah. Yeah. No, I hear you. UPS. That sounds pretty. I'm just surprised you didn't go with Amazon over UPS, but maybe that wasn't.
I'll tell you what, at UPS, we certainly had to keep up with a lot of Amazon's crap. That's like, oh man, the Amazon returns at the UPS store, that was something else. You have no idea how many things people will buy, like with full knowledge that they're going to return them. People would buy 20 shirts and come and return 19 of them. It's like, oh yeah, I just wanted to find one that fits. It's like, you're sitting here with 19 shirts right now. What are you talking about? But
yeah,
it's
you know what that reminds me of?
I was getting paid for it.
Yeah. It reminds, so I was originally working at Sonic. I worked there for 3 years. That was my first job, but it reminds me of customers like, this was the wrong shake. I open it 75% finished. I'm like, I don't really care. I'll go make you another one. But I always thought that was funny, and that's what it reminded me of.
Yeah, it's like finishing your meal and then being like, this isn't what I ordered. Yeah,
this isn't.
Yeah, everybody should work a retail job. Good. Everybody should work a retail job for at least 2 or 3 years. I think the world will be a better place.
I absolutely agree. It builds character and it builds your compassion, because when you recognize some of the just the environment, like I know Sonic is unique in the way that they have all the stalls, so you can get like 10 orders coming in at once and just mayhem inside. But I hear you 100%. Rule number 5, the 10-year test. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. The rule: before making a big purchase, stocks or otherwise, ask yourself if you still want it in 10 years. Now, just reading that right off the bat, I think this definitely comes down to context, right? You know, selling options, this, whatever it might be, definitely comes down to context. But I still see the point that he's making. If things went south, would you be happy being in this underlying? So especially what comes to mind, like a specific strategy is like covered calls, for example. I want to buy covered calls in Facebook, Tesla, whatever it might be. It's like, you know, if the price falls beneath the calls, or goes past the price point that I'm selling, I'm willing to own this stock or sell my shares at these levels. So that's what it reminds me right off the bat. Blue chips. What comes to mind when you read this 10-year test?
Yeah.
Gus? And have you applied this? What were you doing 10 years ago?
Oh man, well, 10 years ago I was buying watches I didn't want for 10 more years, and I was returning them apparently, as we've already established. No, I don't think that this applies before a certain age. I wouldn't say. I'm not sure exactly when that age is. Maybe 18, 20 is when you should start kind of having this mindset. Before then, I say just buy the ice cream, man. Who cares? But my This to me, and this isn't something that I can personally relate to, but I know it's a very strong sentiment among this community. This to me is boats. This is a boat. Everybody always says the two best days in a boat owner's life are the day you buy it and the day you sell it. And it's because you don't have the 10-year foresight when you're buying the boat. You're blinded by the excitement of wanting to acquire the boat, to think about how much of a nuisance it might actually wind up being. You gotta, pay for fuel, pay for maintenance, pay for somewhere to put it, pay for a dock periodically, maybe pay for someone to operate it if it's a larger vessel, and all these things really mount up, especially when it's something that you can only go have fun with on occasional weekends, and most boat owners wind up super burnt out. So this to me is, I rename this, I decree this is the boat rule. Don't buy something if you're not sure you want it in 10 years.
No, I like the boat rule. You kind of, when you tapped into a little bit of like marketing tactics, you kind of get sold on how it might feel having it, what it might look like having it. And that's just almost like sales 101.
But the same thing can absolutely happen in investing as well. It's like I was talking about the snowflake example earlier. I got so hyped up by the social media hype and by the potential that I didn't think about it. I didn't think about the future at all. I thought about tomorrow and I bought a losing position. And so that's absolutely holds up there as well. But boats, I just think, are a very pronounced and recognizable example that people might be able to relate to.
No, 100%. I know another thing is that I would try to do with certain positions that I take. I think about the risk associated with that position, and it's like, will I be okay? Like I try to think emotionally, like in my head thinking, if this outcome goes south, like, will I be genuinely okay with that? And like, not just saying it, will my behaviors
you got to make sure you're not just saying
okay
it.
with,
you got to make sure you're not just saying it too.
Absolutely. 100%. Because a lot of times you're like, yeah, I'm comfortable with doing that. Then after the fact, it's like your behaviors don't show that because you just took 3 more trades or whatever the case might be. So it kind of like similar point here. You want to buy the boat? Just think about it. Like, what if would I be okay with being in that standing? And it's like, if yes, go ahead, buy the boat, guys. Go ahead and buy it.
Yeah, and I'll throw out a kind of random example here too that just popped into my head just now. This is kind of like weird one. This is like rebounds from dating. You get out of a long relationship, you're crushed, and you think, oh, I'm just going to jump straight into the next thing, and I'm going to be okay. And then it lasts 1 month and it ends, and now you're just double sad. That's sort of the same thing that we're talking about here as well.
Double sad.
You should always, you should be thinking along the long term always. I mean, and everything you do and everything you buy. But again, there's such a delicate balance between all of these rules because you don't want to let the future consume you. This 10-year test, this mostly applies to bigger ticket items or larger stock purchases that, could be influential. I'm certainly one to throw $300 at a position on a whim for every now and then. But if you're going to be, if you're putting 20% of your portfolio into something, say, even if it's an ETF, these are the questions you need to be asking.
Yeah, no, definitely. I know the market's been selling off. Who knows if we make new lows? I don't know. But I know that provides great opportunities for some of our long-term investors out there. So we'll see what we get. But that's another thing to keep in mind. That was the rules, the 5 rules that we got from Warren Buffett. Anything else we want to add on to this before we wrap today, guys?
No, I got nothing left on the end. You guys are making me laugh and chat over here. Mike, I've heard about your your cheese grating job before. Mike had lots of odd jobs at the carnival, I think. Mike, if you want to if you want to tell your rat in the grease story, that's a fun one.
The rat in the grease. Man, they're frying everything out here nowadays. No, that's going to be it as we wrap today. I hope you guys enjoyed this segment. We'll be coming out with more like this. Risk and reward, Gus. I really like this. Risk and reward. And anything else you want to let people know that they can expect moving forward?
Yeah, I like it too. Risk and reward. Full rebrand coming hopefully a week from today. So yeah, everybody get excited about that. It's finally not going to be a picture of Julia and then me all of a sudden. So.
That throws me off every time when we hop. I was like, whoa.
Yeah, the first few times people were like, "Is Julia okay?" Yeah, Julia's fine. Everybody. She walked by right out here 10 minutes ago and waved at me. She's good.
Yeah, there we go. I hope you get your cats. I hope that works out. I think the Bengals are really dope. I know those are some crazy cats too. But anyways, was looking at a few not too long ago. I'm not a cat guy.
I'm a Bengals fan.
NFL
are you really?
Wise, so, you're a Cincinnati fan?
I am. I grew up there.
That's so random.
I grew up there.
That's not random.
Yeah,
that's not random.
I lived in Cincy for 10 years.
I was expecting
Bengals,
like the
Bengals
Texans or the Cowboys or.
No, only Texas team is the Rockets. I had no NBA before then, so picked them.
Okay. I got you. Well, that's going to wrap it for today's segment. Everybody else, thanks for taking the time to hang out with us, and we'll see you guys next time. Peace.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
How much does it cost you guys to do simultaneous hair flips?
Years of practice.
If you missed the live show, here's our cherry on top yearly recap.
So, we're doing the show on Friday, and the bat, he's doing the show in the morning, then he's going away afterwards, right?
Yeah.
He's all packing up the car, he's doing his stuff.
RV.
Packing up the
Packed
RV.
up the RV for a 6 to 8 day trip. We're supposed to be there about
4
48
days.
hours.
I bet him $20, and I said, you'll be in a hotel by either the first night or second night.
Oh, and then I vociferously stood up for you.
Of course you did. You should have, because that was the smart move.
Appreciate you. You're
Yeah.
Saturday morning, I look at my phone, and it says Venmo, $20.
I almost had to pay him $40 because there was a little stipulation. If we didn't sleep there one night at all, I'd have to double the bet. I almost had to send him $40.
What happened?
See what happened?
Here, what happened was
we're driving up there. It's absolutely beautiful. It's like sunny as can be.
Because you were tweeting pictures.
Oh, yeah, it was beautiful. It was
On
beautiful.
Instagram, you're like, I'm here in the woods.
Absolutely beautiful. Absolutely beautiful.
Amazing.
It was gorgeous. We were gonna make a slight right-hand turn. We got about 10 miles to go, and up ahead there's like this dark cloud, and it's raining. It started getting muddy, and dogs are getting all muddy. Wife's having a little problem. Bugs are everywhere from the rain. And I realized at that moment that my wife was not a camping gal.
That's a surprise.
So at 6 o'clock in the morning, I pulled everything out, closed everything up, shoved everything underneath, and I was home. We actually left because we did the show at 10 o'clock in the morning. Let's say we left at 10:30. I was home at 10 o'clock in the morning the next day. Look at him.
You were just
jumped in my pool, looked back at my house, and I said, why would I ever leave? Why?
He was going to go fishing, catch.
He's hurt on this one.
Muskies. Some bass.
Very quiet. I left Friday at 10:30. I was back Saturday at 10.
AM?
Yeah.
You didn't make it 24 hours?
No.
Who broke down?
They all did. They all did. I rented a boat for Saturday, but the boat was broken. It rained for 5 hours. You know, when we got there, it was.
Now the RV on rvtrader.com.
No.
Yeah.
Whoa, wait a minute. How do you get to Florida now?
I don't care anymore.
Oh my God. First of all, I'm sitting in the captain's seat. I've never been invited to come sit in the new captain's seat. But what I'm concerned with is the size of these screens. And then he's still doing this.
No, let's take a look.
They did not hold that rally at all.
Phil, you got a partial.
973.75. I'm looking at this like I have to move my head to get through the top, the top symbols. I thought he had like a little computer and he was getting down.
He hasn't learned that he could like swivel his head. He has to see the screen. He has to go like this to me. And then, you know what? Money goes to money. You did it. Good job out of you.
Yeah.
I just drove with him twice. Now I'm really concerned that I was just in the car with him for 2.5 hours. Okay, I need help understanding. This is the largest monitor that I've ever seen. Like, I have to move back in order to see everything. And somehow when you're on air, you're like looking at this, you need some help.
Nope, I got everything fine. The problem is I just have a lot to do. You see, because in your job,
here we go.
Really, all you have to do.
Get the full scoop by checking out the archives at tastylive.com. If you missed the live show, here's our cherry on top weekly recap.
You became Chicago's most eligible bachelor. What year was that? That was the debate we were having earlier while you weren't on the show to defend yourself.
1988.
88. So Vanetta was right. Late 80s, early 90s.
You mean when I was on the Oprah show?
Yeah.
Yeah. Well, 88. I had flowing locks like Tom.
Oprah just made it.
Oh, here it comes.
I mean,
she felt bad. She felt badly for him. You couldn't get a date.
You get a car. You get a car. You get a Scott Sheridan. You get a Scott Sheridan.
I want the car.
That's right.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
It's Tuesday, March 25th, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's evening show. I guess another one of Tasty Live's evening shows, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. It's Tuesday, my babies. You know what that means. We brought the big brain in here. I'm talking, of course, the global head of macro here at Ilya Spivak, a man who, if you gave me 3 hours with him on a weekly basis, it probably still wouldn't be enough, and we'd still run over time by 15 to 20 minutes. Talking, of course, of Ilya Spivak. Ilya, how are you, my friend? Very good. I wish the markets were doing something more exciting, but otherwise, the weather in San Francisco was absolutely gorgeous. Oh no, absolutely not. I will not let you open up with weather talk. I'm shutting it down right now. What you were talking about, talking about before we came in, was 23andMe. This is more interesting of a topic. That's right. So tell me, you when I came into the room, you were talking about you deleting your 23andMe data. That's right. Just in case anyone is not following this story, can you do me a favor? Set the table for why, in God's name, you're scrambling to delete your
I don't know about scrambling. I will say the website was slow yesterday, so clearly there was quite the volume of folks. But story came out. I first saw it via friend of the show Chris Vecchio on ZDNet, and then New York Times picked it up later. By then, of course, I'd already acted, but it became zeitgeist after that, and the website meaningfully slowed down. But 23andMe, which is a company that took your DNA sample and then told you about your genetic composition and any kind of fun factoids that they could come up with, they went under. They declared bankruptcy. And through this, they're going to, of course, go through a process of disposing of their assets, including their data. And so they gave their users the option to go destroy their data that they had on file with them if they wanted to. Now, I wasn't so crazy as to ask them to keep my DNA sample. That you can opt into, but I didn't do that because why? But I did go and delete my data, and of course the moment you press the delete account button, you can't log into 23andMe immediately. So they're telegraphing to you, look here, we're doing the thing that you asked, and you kind of have to trust that they did what they said.
Yeah, I think, I was telling you before we started, like, I don't know, some people, I don't know, maybe casually I might get labeled a conspiracy theorist every now and again.
Unfairly, I would say.
I personally don't think so. The way I think about my views of the world are most things. I think truth is on a spectrum, and so I try to allow myself to understand that there's a tail risk to accepting truth on both the left and the right tail. So I'll give you the story. Somebody in my family bought me this 23andMe gift. This was several years ago for Christmas. And Christmas morning, in front of everybody, I go, I know how much this costs, and I know that money means something to you. I appreciate the sentiment. Please take this back. And I never do that, by the way. I always smile and grin and say thank you. And if it was a $20 thing, I would just say thanks. But I said, there is 0% chance I'm going to send in my DNA to some private company somewhere just to find out I'm 2%, this or that. I'm pretty comfortable in my own identity. Whatever my grandmother told us about our family history, I'm comfortable with, and I'm not going to do this. So take it back and keep your money. And I think at the time, anyone that said, don't send your DNA to these private companies, people are like, oh, you're a nut. You're a lunatic. Now all of a sudden, it's funny when that tail risk starts to hit, and but the thing to me I could not understand is isn't that data for me personally? Doesn't that have value? Why would I be paying you to send you some of my most valuable personal genetic information? Why in God's name am I paying you to do that? Like, to me, the value proposition was inverted.
The argument is that you're paying for a service because you have no way to process your saliva into that data, and they do. So what you're paying for is them taking your saliva, doing their magic science dance, and telling you, well, turns out you're blah, 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 blah.
Bro, I would just do, you know what I would do? Is I would just, if I wanted to get a bunch of people's DNA, I would just put some randomizer on there. I would get some DNA and then put some randomizer that just sends you back some DNA stuff. That's why I think people's answers are so wild, you know? Oh, I'm this. I just
mine were not wild at all. The crazy thing is, I thought mine would be wild because I mean, I was born in Russia. I'm from the Soviet Union and ethnic hodgepodge. I have roots all over Central Europe and into Western Europe that I have traced back, great grandparents or so. And I thought, man, this place is so mixed. Surely I'm going to have a kaleidoscope in there. Nope.
Mm-hmm.
Not at all.
Wow. What a great business model. When you really think about it.
Well, apparently not. They've gone bankrupt.
I don't know. I'm guessing a bunch of people made off with a bunch of sweet cash for that, and now there's just an empty shell of a company that has to be dispersed. Somehow, that's the open, my friends, to a trading show. Welcome, everybody.
If you're watching, you can short 23andMe, spoiler alert, you can't.
You cannot anymore. Shout out to everybody watching on tastylive.com, as well as those watching inside the Tasty Trade desktop and mobile applications. But if you want to be part of the chat box on your screen, there's only one place you can do it. That's on Tasty Live's YouTube channel. Evil YouTube channel. So head on over there. Start bashing your face against the keyboard. If you're already at the keyboard, you've got some metacarpals or phalanges, you know what to do. Start making them dance, baby, so we can spoof the Google algorithm into putting us in front of as many people as possible. Ilya Spivak, I asked you this question, and it stuck out in my mind since last week, which I think was a Wednesday talk. I think we did the switcheroo last week. I can't really remember.
We did.
So last week I asked you, what additional bad information could come out of the administration? Doesn't it feel like we're kind of at peak bad information? The irony of that conversation, it was pretty decently timed. Because not only did you get sort of this relief rally on nothing at the beginning, just on pure price, and I think risk reward from the market's perspective, probably a vol crush that also helped to lift the market. But then you also get some sort of wink, wink, nod, nod from Trump the other day on the potential easing of the worst case scenario of tariffs. Again, I'll believe it when I see it. Put something in front of me on April 2nd, and I said the worst case scenario is on April 2nd. You just get enough, and then there's another date. And that seems like what they're doing. This is going to be a multi-date scenario. April 2nd, you'll get some tariffs and some information on some countries, on some products. And then this will be a longer drawn-out scenario. So there's really no vol crush coming on the opposite side April 2nd. Anyways, your point, your perspective on the risk rally that we've had and the changing of the narrative that we've seen in just a few short days.
To me, I got out of my stock short exposure ahead of the Fed because this is what I thought would happen. I just thought that it would happen sooner. I thought that what we were going to see was a more meaningful rally ahead of the Fed on the idea that the Fed was going to come and say all the dovish things that everybody wanted to hear, or at least to just commiserate with markets. Because the message from Washington was, we don't care about this sell-off. The economy you see is wrong. The data you see is wrong. Goodbye. We're not coming. We're not going to change anything about how we're doing things or what we're doing. We're not concerned. And so what the markets wanted was essentially a shoulder to cry on. They wanted for the Fed to come out and tell them, we see you. We see what you see. We're not concerned, but
we are on we've sat up in our seat also. And that's what they got. And I thought the markets would expect that. And I thought that what you saw in gold, what you saw in the dollar was already giving you a sense that that's where the market was tilting. But then yields didn't run and stocks didn't run, and they waited for after the Fed. I thought what that meant was that going into the Fed, the bar was relatively low. The Fed didn't have to say a lot. They just had to kind of nod at the markets and go, us too, us too. We see, don't panic. And they got that, and the markets liked it. And, but for OPEX on Friday, once you kind of got through that and into this week, I thought there was a relatively green light for risk just because there's not a big macro event on the calendar this week. There wasn't really a whole lot of reason for the markets not to follow through. The Fed basically gave them license. Mm-hmm. I don't think it changes the bottom line, which is that all of those things that we've seen in survey data, all of those things that we've seen in kind of second tier, third tier economic data, that stuff's still there. And the real question is, does that stuff show up in a big, meaty, hard data release like NFP next week? Maybe it does, maybe it doesn't. But I think the markets are going to start to think that maybe it might by around Wednesday of next week. And so what that means is that maybe you run into the underside of this range around 5,900 on ES, the place where we saw the markets kind of stalling before the breakdown. Sort of if the top was around December, then in January, mid-January or so, we established a kind of swing bottom, came back to retest those December highs, and then sold off. So that underside is, call it 20 to 40 index points around 5,900. So like 59.60 down to maybe like 58.40, something like that is sort of that area. We're heading there now, I think. I think there's a little bit more upside this week. I think we'll test there. But ultimately, I want to be a seller into basically the market's going right. Now we have the first real test of what the Fed is telling us in hard data. And before that, we're going to lighten up. And then, of course, if the hard data is soft, then we're off to the races.
There's a joke in there somewhere. Let me. I'm in the same camp here. That this is we're headed towards. We're finally getting into an area where the easy money has been made. Right, that easy vol crush money. And I say easy, but it had the best risk. It had the best risk to reward to it. But obviously, it was most uncertain when you made the bet. But clearly, you got the best price. So that money has been made, and now when the all clear sign is here, right, when the narrative has flipped, when maybe bonds have normalized a little bit, when growth expectations have gotten a little bit better week over week, when vol has sort of the vol term structure is normalized, now all of a sudden you might feel good putting risk on the table, but guess what? You're at the resistance area of the previous value of the previous range. And that's the sick part of this game. And I sort of agree with you. Like, we might get a little bit of a fade here. But I just don't know how long-lived that's going to be. I think the Pavlovian response here, is you just got taught again that, if you take risk at difficult moments and you don't get scared, you're going to get paid. And now that risk is relatively cheap, right? So NVIDIA on a relative basis to itself is cheap. Tesla relative to itself is cheap. Apple's relative to itself, you get cheap. And so the hard part of this setup is if you get a risk fade, Ilya, why wouldn't anyone just go, oh, finally, I'm getting Tesla a couple dollars lower. I missed it last time. I'm going to put some chips on the table. So I think it's going to be I think we're in a sort of a real interesting level and area where we can see a lot of two-sided trade. And I'm not going to be so quick to get on one side or the other here. I agree with you that probably the chart says the trend is down, but I think we're playing a card game, and when I look at the card game, I'm like, this could very easily chop around, and I probably want to be intellectually flexible here and just give what the market is, take whatever the market is giving me.
I think you always have to do that.
For sure.
I mean, look at the down move in 2022, which was a persistent year of losses. Was it a straight line down? Of course not. It was a grinding, choppy stair step. And I think we're in a down move, and I think the reason you don't go bargain hunting is eventually you realize that the growth risk is real, and that this isn't a sentiment spook. This is a real readjustment to a weaker economic cycle. I think that's what's here, but that doesn't mean the market has to buy that idea now or later or when. And so I think you always, to your point, you have to take what the price action gives you. Have your bias, but strong convictions loosely held is the motto.
So let's pick apart something you said in your opening here. You just talked about whether or not this is a quote unquote growth scare or whether this is a bona fide growth deceleration. And I think if I turned on a couple of things today. I can only watch like 5 or 10 minutes now. I turned it right back off because I just knew what I was going to hear, man. I knew that the sentiment was going to follow price, and I knew when I turned something on, I was just going to hear a bunch of people like, I think the growth scare has been overdone. I think this, that, and the third.
But that's how it always works.
Money to work.
The markets move, and they go to their Rolodex of the people that come in for interviews on that side of the market.
Yeah, I saw Kathy Wood's interview calling for Tesla 2900, and I'm like, oh, that's where we are. Okay.
It's like,
but I think the justification for this was a bit overdone in the short term, and this is really more of a rotation to a broadening out. That's what they've been saying for I don't know how, like half a year. But the justification is that the scare is in the soft data and not the hard data. This was in your opening. Pick this apart. Pick that theme apart. Why are some people looking at, and explain soft data versus hard data, if you could, and explain what you see happening in the relationship between soft and hard data, and I'll sort of give the case for the opposite side, even though I don't believe in it.
Sure. So soft data, hard data, right? These are obviously not scientific labels, right? This is shorthand. These are not official names of things. Jay Powell described them this way at the last press conference, and so of course the conversation around the water cooler, as it were, the global water cooler, is taking in these terms, and they're showing up more now. But the upshot is that soft data is we went and asked business leaders what they think is coming in 6 months.
Yeah.
That's, let's say, the PMIs. Hard data is here's what they actually did. Here's where the money actually went. Here are the numbers on employment. Here are the numbers on inflation. Here are the numbers on output, on industrial production, on durable goods orders, blah, 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 blah. Right? There's what they said, and then here's where the money actually went. The benefit of soft data is it's very timely. You can go and you have March sentiment numbers that came out earlier this week, the same month. Now, there's going to be a revision where they kind of move around some last minute numbers and they get the full sample size, and there might be some revisions. There were last time that were notable, but the main value in these numbers, be it the consumer confidence numbers from the University of Michigan, which are very good, or the S&P Global PMI numbers, which are also very good, the key benefit there is timeliness, because the PMI numbers approximate GDP pretty closely. But GDP is released quarterly and with a huge lag. So if you wanted to get a sense of where the business cycle is, this is a good indicator, but it's not enough to move the Fed or any kind of major central bank off its square, because what it's thinking about is 2 years, 3 years at a time, not a quarter at a time. And it doesn't need that timeliness. It can wait for GDP numbers before it makes some sort of a tectonic policy shift. It typically likes a few data points of the hard variety, where you actually see, okay, this many people got hired or fired, this much retail sales activity was had, this much industrial production, this was GDP, before they decide that the economy has done something different than what they expected and they have to adjust, obviously with the exception of there's a collapse of a giant investment bank and they have to scramble, or credit markets have seized up because of a pandemic, suddenly emergency moves. That aside, the Fed basically told us last week, okay, listen, maybe there's some sort of a downturn, but so far we've asked people and that's what they see, not it's there.
Yeah.
We got to wait for it to be there.
And to me, I think that it makes a lot of sense. We had said that when you're looking at the Atlanta GDP now, like, don't take this as gospel for a GDP reading at this point.
No.
And so I sort of think that makes sense. I'm not a big fan of survey data at all. And I wonder, before I ask you my next question, if you could just respond to that sentiment. I don't love survey data. I take it mostly with a grain of salt.
I think the PMIs are great. But I think the University of Michigan consumer confidence numbers are excellent and very useful and give you early leads on all kinds of things. But the much more important thing than what I think, what you think, or anybody else thinks, if the data is market moving, then it matters. And the PMIs have been market moving. The University of Michigan numbers have been market moving. Markets have swung significantly on the releases. And we've seen significant follow through from those moves in the price action. And that's really the most important thing. For me as a trader, I mean, academically, I know why I like the PMIs. I know their limitations, and I'm going to use them accordingly. From a practical trading perspective, if the market is going to move on the numbers, I've got to know what they are. I've got to know when they're coming out, and I have to know what the expectations are, and I have to have some kind of an idea in my mind of what I think they're going to do, so that I can have an idea of what I think the market is going to do with them.
I understand. This isn't the hill I want to die on today, so maybe I'll circle back on this one a little bit later. Let me ask you. I listened to something from Jim Bianco.
Yes,
and
the great Jim Bianco,
the legend. And what he had this interesting point of view. He's done this type of call in the past. He said if the Fed doesn't get it cut off by May, then the likelihood that they're done for the rest of the year is pretty high. He thinks if they don't get it cut off by May, that in the face of a growth scare, the GDP numbers, as you mentioned, some of these surveys, if that's not enough to sort of move them, then he thinks that they'll just sit tight for the rest of the year. And in fairness, I think he made a call like this last year. I think he said if Jerome Powell didn't cut by some point, like prior to September, that they wouldn't cut at all, because he thought that they wouldn't want to be seen as political, and if they started cutting around September, stuff like this, that's right in the primary season leading up to the election. They can be looked at as trying to help the incumbent administration. And that ended up not being the case, right? So they did cut in September, and they cut November, and they cut in December.
Sure.
So I put that put that out there. No disrespect to Jim. And so I wonder, what do you think about that mental model of thinking if they don't get something off by May or June in the face of all of this uncertainty, then they're likely just going to sit tight for the rest of the year? What do you think about that mental model?
I don't think that's likely because I think the Fed is telling you what they're going to do, and their bias is clearly to cut. And I'm not inclined not to take them at their word unless circumstances change. And obviously, if circumstances change, we'll know that before the Fed announces it. The markets are going to start speculating on what the Fed may do long before the Fed does it. In fact, this is what this has all been about since mid-February. The market's saying the Fed needs to ease more because there's a growth scare, and the Fed going, okay, we hear you on the growth scare. We're not ready yet. We don't think that we're seeing enough evidence to feel urgent about this right now. This is sort of the give and take that we're looking at. But the Fed's been telling you that they're cutting rates for a long time, before there was a growth scare. They told you back in December, before any of this, that they're going to cut rates 2 times this year. And it's because of maintenance. Because they think, for obvious reasons, that if inflation has cooled, as it has, if it continues to cool, as they want it to, inflation expectations will come down. And as that occurs, and they've been, and as that occurs, what you'll see is real interest rates will surge if you do nothing. And you can't allow that to happen because that will crush the economy. So the real cost of borrowing is nominal interest rates minus expected inflation, because obviously nobody knows what inflation actually is. You can only benchmark it to a basket. And then what inflation is going to be in the future, I mean, that's a complete black box. And so what people do is instead they benchmark inflation expectations, and you can see them as break-evens in the bond market. You can look at the swaps market and look at inflation swaps, but you can see what the collective wisdom is of the markets on where inflation is going. And if you were to let inflation expectations decline because you're being successful in normalizing monetary policy, and the market believes it, and inflation comes down, as it has, and you don't move nominal rates, then nominal rates minus a lower inflation expectation is a higher real cost of borrowing, which then makes it more difficult to invest, more difficult to purchase things in real terms, in inflation-adjusted terms, which is really the terms that matter. So the real purchasing power of people and businesses is diminished because their cost of borrowing in real terms is higher. That's not what the Fed wants. They don't want to crush the economy. So they've been talking for a while about a consequence of seeing what we're seeing on inflation. Because we want to be successful, we're trying to be successful. As we're succeeding, we're going to need to cut rates so that nominal rates are pacing closer to inflation expectations. Powell said at the press conference last week, was very assertive about this bit, that the current setting of policy is clearly restrictive. And if you want to normalize things, you're going to have to come off restrictive toward whatever neutral feels like. And Powell has long said, there's no way to know where neutral is. We know it by its works, which is one of the great quotes from a central banker, I think, ever. I now tell my children that I know all kinds of things they do by their works. And so as all of this is occurring, the cuts were already there. I think the Fed, in the best case, is going to want to cut for the maintenance that they already envisioned. If they're not cutting, it's because the sort of stagflation-ish thing they wrote down in the SEP actually starts to come to pass. And I don't think we're there. I think that's probably an outside risk. As you and I have talked about, I buy what the Fed is saying about an economic slowdown and their revision in the growth forecasts. I'm not sure I buy their upside revision to inflation.
I agree with that. I'm going to pivot off the Fed for a little bit, and I want to go into U.S. versus rest of the world.
Sure.
We've seen over the last couple of months, really, pretty strong nominal performance. I know you're going to throw in the currency impact, but pretty strong nominal performance of a lot of these international ETF or international markets.
Well, I mean, any way you slice it, they've held up better than U.S. markets by a long mile.
Yeah, so the TINA trend and the everybody splash your money in the U.S. markets, in a little way, that's paused, if not reversed, over the last 3 months. And I'm curious, what Ilya Spivak, what do you think about that trend that's played itself out over the last 3 months? Did you think that it's sort of a healthy correction, a reversion in some way? I know price doesn't revert, but you get what I'm saying. Or do you think that's a longer-term trend that can continue to play itself out, that money, which has just been constantly flowing directly into U.S. markets as we re-engineer trade and the terms of global trade, re-engineer monetary policy, that the net impacts of those things are capital not necessarily draining straight to the U.S., but perhaps spreading the chips out across the table a little bit? How do you see that theme playing itself out on a longer-term basis?
I think it's going to continue. I don't necessarily think that you can expect it to happen in a straight line or anything approaching a straight line. And I don't think it says anything about the long-term centrality of the U.S. or its domination of the global economic system. I think you have a much simpler story here, and it feels tempting to look at this and say, this is some sort of a major tectonic generational shift. And I think that's not really what you're looking at. So all of the folks out there that have been crowing about the demise of the U.S. dollar, some sort of a new reserve currency, some sort of a rise of a BRICS currency, keep dreaming. That's not happening, as far as I'm concerned, and won't in our lifetime. But what you are seeing is, to your point, the re-engineering of the global trade system means that the U.S. is actively trying to do less business with the rest of the world. At the same time, what that has meant is, for example, in Europe, there has been one of those forcing functions that the Eurozone and the EU typically need to get to the next level of regional integration. They've decided that they can no longer reliably depend on the U.S. security umbrella, at least for X number of years forward. And that what they need is now a massive military buildup to have a military deterrence and a nuclear deterrence of their own that is robust and fully backstops what the U.S. may or may not do. And they have turned that idea into the kind of rapid action that you never see from European capitals or from Brussels unless there's a crisis. And in fact, this is the whole story of the EU. The EU comes together really to prevent Germany from rolling into France a third time. That's really the entire mission of the project. When you look at the initial communities that make up Europe, it's European atomic energy and European coal and steel, which basically give France a say-so over German military industry in the wake of World War II. So this entire thing has always been about, we will fudge the economics if it means we get a security and a military benefit, because those things are themselves economic goods. It is almost certainly better for the prospects of the French economy that Germans don't roll tanks into Paris. And so to prevent that outcome is an economic good that perhaps is worth the price of creating a currency union and an economic union that is subpar in terms of its construction, what Robert Mundell would call an optimum currency area. The Eurozone is not that, as Mundell himself argued. And so what you've seen these fissures show up. And every time they get closer and closer, it's because of a crisis. They admitted Greece, Italy, Greece, Spain, and Portugal to secure democracy there, though the economics were not there. That was a security move in the middle of the Cold War. The moves they made to safeguard the euro during the 2011-2012 crisis, unprecedented. Nothing that the Germans could have been expected to go for before, but they did. I think we are now looking at all of those things that Europe thought were sacred cows. They're getting slaughtered as we speak here. Things like debt mutualization, defense unification, all of these things, including, by the way, with the UK. So Brexit or not. So what we're seeing, I think, is a wave of defense spending that's going to come to Europe. Bonds are already starting to show it. The euro is starting to show it. The pound hasn't shown it enough, probably has room to show it some more. And that's going to be something that's going to attract money, because that's a lot of money that's about to start sloshing around in Europe. That means higher yields. It means more inflation. It means more earnings and more orders and more just general economic activity for the locally listed names. So yes, I mean, I think that's something that's not going away. It's not something you, I think, can bet on unilaterally if you're a trader. If you're a trader, you're coming in, you're going out, you're being more tactical about your exposure. But I think this is a multi-year trajectory, much as I think, well, certainly people say that, and the famous quote goes that in World War II, Japan awakened a sleeping giant in the U.S. I think this time Russia has awakened one in Western Europe, and it's not going away.
So where would you be, it's a simplified form of this question, but for the purpose of being actionable, outside of the U.S., where would you be putting an incremental dollar?
So my way of trading this so far this year has been to be short dollars against European currencies, because before you see earnings, you see the inflationary impetus, and that means fewer rate cuts. The euro, being long euro, has been the best performing trade for me so far this year, and I was short stocks the entire way down from the peaks down to the lows a week and a half ago. I got out ahead of the Fed. So this has easily been the best working thing. And I mean, I was short dollars until earlier this week. I actually cleaned up the portfolio as we were talking on First Call with Tom this week. I got out of all of my short dollar exposure. I think it's kind of had a run here and has moved into some sort of a digestive phase. But for me, this is the actionable way to participate in this idea, to buy euro, to buy pound, and if it's a risk-on market, to also buy Aussie and Canadian dollar. And if it's not, then not those. Those have underperformed. Europe has outperformed. The yen, of course, has outperformed before and has really paced closely with the euro. But this thing is a creature unto itself. And is mainly reflective of yields. I mean, if you look at what 6J looks like here, and then you look at ZB, the chart is the same. So I think that's more a yields thing, and I'm long bonds. So I'm fine with that for now until it's time to buy some more yen. But I think the way you participate in the European military buildup before you can really count on the earnings showing up and giving the stocks a meaningful rise, or at least for the earnings to even be anticipated in the markets, bonds, yields, and currencies are moving on this now. And there's certainly no reason not to participate there.
I want to pick up that bonds discussion, but I want to give the April 2nd discussion a little bit of time to breathe here.
Sure.
So Liberation Day is coming. April 2nd. The current president has effectually labeled it Liberation Day, a day in which the idea is that there will be a few announcements, a bit more clarity on the strategy with regards to tariffs, at least on the opening move. I wonder, how does Ilya think about the event risk of April 2nd? Are there positions or risks that you like ahead of April 2nd? What will you be looking for? Any parts of this announcement that you can front run or sort of forecast out or game out? And then any potential opportunities you see on the back end of April 2nd? Like how much have you tried to think through the potentials and possibilities here and game through the risk scenarios?
I think what we're doing when we look at these things is done a disservice if you look at them episodically rather than sort of through the lens of what you've seen so far and what it looks like the goal of the exercise is. And I think we talked about this last week a little bit. Why is it that you're getting all of this combative posturing? It's not just on trade. It's on all kinds of things. Why are you getting it out of the administration? It seems like there is a thread here. And the thread is we are going to throw our weight around to compel people to do things that we think, A, is for their own good, and B, is in the advancing of ideas that probably have bipartisan support, but haven't gotten off the ground because of a lack of urgency or just general muddling around. European rearmament is actually a great segue here. The Trump administration attempted to get NATO to spend more on guns the first go-round. It didn't really stick. Lots of people said lots of things, and then nothing actually happened. So what happens? You get an ugly meeting between the administration and Zelensky, and it creates a sense of urgency. And now there's a European military buildup, which is what the Trump administration has been trying to happen or to make happen for a long time now. The administration comes out and says, we're going to take Gaza. We're just going to take it. And all of a sudden, there's an Egyptian brokered plan for post-war Gaza administration. So as a near-term strategy, you kind of see what's going on here and the way that power is getting deployed to try to create a sense of urgency and a sense of immediacy in outcomes. Now, obviously, these things are going to work sometimes and not others, and some things backslide, like what's going on in Gaza. But you can see a strategic kind of theory here in what they're doing. And the trade thing and the back and forth on it, I think, is misconstrued to think that this administration is protectionist necessarily. I'm not so sure that's true. I think what this is a renegotiation and a way to compel action by stick rather than carrot on the belief that the carrot has already failed.
Correct.
And that there's no more carrots. And so when you get something like, we're going to put all these tariffs against Canada and Mexico, don't try me, I'm crazy. And then, by the way, there's a carve out for everything in the USMCA. And you're like, and also the USMCA is a terrible agreement. Woe be the idiot that created this. Oh, wait, that was me. It's like, no. This is a negotiation. The idea seems to be to broaden the USMCA before it expires next year and have more free trade, not less. And to then posture now for positioning for what that renegotiation looks like, but more importantly, to compel it to happen and to make for more free trade, not less. So I think as you look then at what happens with April 2nd, I think the arc is the same. I think if you wanted to think of this in terms of good cop, bad cop, this administration feels that it's the bad cop. And that what it's going to do is it's going to come out and beat on everybody so that they can then become the good cop, offer them coffee and a cigarette, and have them sign the agreements that need signing. So I think the arc has been, as the critical date approaches, you pass it, the things nominally appear, and then there's a magic saving phone call or a last-minute renegotiation, a last-minute reprieve that demonstrates that if you play ball, the big bad man will go away and the good man with the coffee and the cigarette will come into the room. I think that's what's going on here. I'm not worried about this April 2nd date. I don't think we're going to get some sort of Armageddon level announcement because I don't think that's what they're trying to do. I think they're trying to negotiate and they're just being very adversarial about it. And separately, you can have a conversation about whether longer term this adversarial approach will backfire. Because longer term, it will erode U.S. Soft power and U.S. influence in the world because it will compel people that are currently dependent on the U.S. to become independent. And whether that diminishing of U.S. influence will ultimately be good because it will save the U.S. more money and allow it to focus on other things, or it will be bad because it will be a loss of influence. I don't think anybody has that answer. I think it's a lively discussion, which we can come back to in 10 years' time when we know more. But you sort of see near term what is occurring, I think.
Agreed. I think that was the perspective shared here early and often. I think the market is coming around to this idea. At first, it was sort of funny. People are like, why are we going after Canada? It's like, well, all right, let's try to put this in perspective.
How do you compel people that aren't dependent on you? You have to go for the ones that are.
Right. And so I think there's two ways I see this, man. I look at it like you. I go, April 2nd to me just seems like, Trump's just he's a TV guy, a big date. This so everyone's on there. Correct. This is just an episode.
Season finale, baby. Tune in.
Exactly right. And the media gets to use something to drum up all this excitement. You and I are talking about it right now. The reality is, you look at vol and term structure for at and around April 2nd, and there's no meaningful deviations here in vol for that week or right around that day of expiration. So there's nothing here yet, and so there's one part of me that goes, this is just soap opera. You know what I mean? And I know we're going to get part of the answer on April 2nd, and then they're just going to draw it out, because that's what you do in a negotiation. You time box somebody to create a sense of urgency, and that way you can move the negotiation and progress the discussion along. If you don't have some sort of if you don't time box somebody, it's harder to progress it along. And I think that's just basically what they're doing. That's why you're going to keep getting new dates, and people haven't recognized it yet, right? It was 30 days. We're going to slap the tariff on here. We're going to pause it for 30 days. We're going to pause it for 30 days. We're going to increase the exceptions or the cutouts for all the things in the USMCA. And now it's April 2nd. You're going to recognize at some point that this is going to keep happening because it's useful to the negotiation. That's number one. Then there's a second part of me. There's a second part of me that read Goldman's note, and I try not to make this a habit anymore. But there's a point to this. There is a point to it. I sort of do understand. I'm going to read the note to you and everybody else out there, just in case you didn't catch it. April 2nd could bring negative tariff surprise. From Goldman Sachs. Goldman Sachs economists note recent media reports have suggested the Trump administration is leaning in a more benign direction on tariffs. Don't be fooled, they write. That attitude probably sets markets up for a negative surprise. Goldman notes that the Trump admin has seen tariffs as a negotiation tool. And will likely want to start from a position of strength. A recent Goldman survey shows that market participants believe reciprocal tariffs coming in April will amount to a 9% reciprocal tariff rate. Goldman expects the initial tariff rate could be double that, which would set the market up for a negative surprise next week. And so when I think about the potential for a negative surprise coupled with the fact that the vol isn't really there, meaning people aren't reaching for protection just in case, that kind of makes me think you could see a little bit of something. But I think on balance, man, I'm in your camp where I go, what are you expecting? And whatever you're expecting, you're not going to get.
Well, that's the thing, right? We sort of talked about this when we were talking about the Fed. If the markets had rallied into the Fed, I would think the risk is the Fed doesn't tell them enough, because look at all this repositioning they've already said. Now they need the Fed to justify it. If the Fed doesn't come out dovish enough, markets fizzle because they've overplayed their hand. But no, they waited. And so the bar for the Fed was low. If the markets are going to decide that April 2nd is nothing, that it's going to be another one of those, the big scary man is going to come out and say scary things, and then in the 11th hour is going to get diluted and everything's going to be fine again. And they run with that into April 2nd. And then on April 2nd, the big scary man does a little bit more than what they thought. The risk will be the other way. But if they run into April 2nd,
but I think you just fade it, because think about it like this. Let's say there's a negative surprise, 18% instead of something more reasonable that the market is sort of hoping. They're hoping for 10% ointment and they get something near 20%. And so what happens is you get the knee-jerk reaction, and then everyone was going to do this, have come to the same realization that they're going to go, oh, well, this probably isn't where we end. So if you get cheap, meaning if we dump 2% off a negative reaction, you should be thinking that this is just the opening move at a higher, more aggressive tariff rate, and that you should be moving towards the potential outcome of the base case 9-10% anyway. And that's how the market's going to think. So to me, I think this April 2nd thing, it's a nice event risk. I don't think anyone should take it seriously, and the opportunity for a decent fade regardless. If we're at 6,100 on April 2nd and you get 18%, we dump 2%. If we're at 5,500 on April 2nd and you get 9% or you get 18%, we rally 2%. So it's like,
here's where I'm going to somewhat tactically disagree.
All right, what do you got?
I think when we say it's not a big deal and nobody should care, I think we're downplaying the capacity that people have to lose money in one day. This could be a big move for one day. It could be a big move for 2 days, and then it fades. So for people to go, you know what, the market is a little bit risk off, let's say, because it's de-risking ahead of the event on April 1st, let's say, and they go, you know what, this thing is nothing, it doesn't matter, I'm going to load up on 0 DTE long delta exposure because whatever, you're going to get hosed, or at least the risk that you get hosed is very significant. You should take this seriously, but you shouldn't over extrapolate it.
I agree with you, and that's a good, it's a good note of caution for sure.
It's a disclaimer.
I would say the people watching this show are rational individuals, and everybody here knows that you have personal accountability for the risk that you take on, and it doesn't matter if it's an April 2nd or if it's just a random ass Wednesday.
Whatever it is, yeah. Just don't get reckless, is what I'm saying.
Yeah.
Don't say this doesn't matter and get reckless.
That's true. I guess that's fair. So there's nothing specific. So you're basically, there's nothing specific that you want to position into, and there's nothing specific that you're looking for on the tail end of this announcement.
I don't like
Would you say that's fair?
Risk in general, like as a standalone. So like, get long or short before an earnings announcement or an economic number or a policy announcement with the idea that I'm going to catch a spike and then be out after. I never trade that way. My average holding period on a winner is about 3 weeks. My average holding period on a loser is about a week. So I am quick to cut. I'm very mindful of risk reward. I'm not looking for event risk to make or break anything I'm doing. So I am not doing anything with April 2nd. I think it might be one of those event risks that is more consequential in its passing than its substance, in that whatever occurs. And then the markets go, right, okay, event risk out of the way. Now what? And then you get the real thing that markets think. And maybe it's risk off. Who knows? But I don't think anything is going to change on that day that's going to make or break the next month. I think if something does occur in its wake, it's because that's what the markets were going to do, and they needed the permission to do it by the event risk getting out.
The only thing that, what makes me nervous? I can be a wild person. The only thing that makes me nervous is the title. In government,
it's not a good title.
In government, whatever they name something, you should be concerned about the opposite. The Inflation Reduction Act. Liberation Day to me is terrifying when it comes to the government. It's terrifying.
Horrible.
Because it means historically, it means the exact opposite.
As somebody forever scarred by Soviet nonsense,
Liberation Day makes me so nervous.
Anytime I hear these kind of, we're gonna win like we've never won before, I'm like, oh no.
No, that line, I can deal with that line. That's just like a filler line.
All of it. Any kind of
Liberation Day is something somebody sat down and they thought about, and they want it framed this way in the mind of the public, and that
any triumphalism at all. Any triumphalism at all. Any kind of the government screaming with perfect confidence that the great and powerful future has arrived because they're so great. Any government, anywhere. I immediately go, oh no. Oh, this is going to be the exact opposite, isn't it?
Yeah, bro. I've never been more terrified of a label in my entire life.
Like they say Liberation Day, you immediately go, oh, the purge. On April 2nd, we're going to get the purge. Here we go.
I'm so terrified. I have liberated you. It's like I look up and the S&P's at 5.
Delete 23 and me.
Delete it quickly. Been liberated from capitalism. What? No. I suppose real quickly, I'm going to talk internal market themes real quick.
Sure.
Sometimes you play this game. Oftentimes, it just depends. I think most of the time you're playing at a high level, at the index level, not necessarily the sectors. But I'm curious. I'm going somewhere with this. I'm going into materials. I'm going to end up at copper and Freeport-McMoRan, just so you know. But of the 11 sectors, is there anything you like, anything you don't like, given the macro backdrop? You know what I mean? Like yesterday, discretionary sector was on fire. Tech was on fire yesterday. Are there areas, given your macro backdrop, that you kind of like, or that you kind of would avoid, or on a relative basis, or is that not the game you're playing right now?
Right now, I think that is a very difficult game to want to play, because what you have to do to play that game. And by the way, this is the game that you mostly play, because most of the time the economy isn't contracting, it's growing. And most of the time you look forward to it finding some sort of acceleration. And so for most of your trading, investing, whatever your interaction with the markets, your baseline kind of logic is, I am looking to find the thing that's going to go up the most or otherwise deliver the greatest possible return and be there. My job is to maximize how much money I am making given a level of risk. And that's most of our engagement. Unless you're in a risk aversion sort of situation, and the entire logic changes. I was really having a lot of these conversations when the Eurozone debt crisis was going down and thereafter, and people going, well, how does it possibly make any sense for people to buy German bonds that have a negative yield? So you are actually paying the German government to lend them money. And the answer was, well, it's because nobody cares about return. What people care about is safety. They're buying insurance. They're not investing in these bonds because they think their return profile is superior. They're paying for insurance to keep their money in a liquid, safe spot because everywhere else is scary. It's a different logic. It's a different underlying thread for participating in markets. It's a whole different lens. The things you value in assets change completely. And I think we're now in an environment where if you're going to play the sector game, what you have to believe is that the environment itself is constructive. And now you're going to try to look for outperformance in this constructive environment. And I'm not so sure the environment is constructive. I think the environment is actually not. I think we're looking at an economic slowdown. So I don't want to try to pick even sectoral winners, never mind individual names. To me, it's tactically selling the index when the opportunity presents itself in a trend that seems to be starting to develop. I mean, yes, you could do the kind of recessionary portfolio thing where you could say, well, okay, well, year to date, stocks are down about 2%. If you look at the S&P, consumer discretionary is down 8%, tech is down 6%. Obviously, those are the most economically sensitive areas. Energy is up a bunch. Consumer staples are flat. Healthcare is up a bunch. That's very defensive. So is energy. So you look at all of that and you go, okay, well, the market is kind of doing a rotation thing for an economic slowdown. You could do that. I think you run the risk in this environment of correlations going to 1 and there being a liquidation type of thing where all of this differentiation doesn't matter. Or at least I think the risk of something like that is high enough that I don't really try to get that nuanced. I try to say, here's my equities bucket, it's indexes. Here's my rates and fixed income bucket, it's bonds. Here's my FX bucket. Here's my metals and commodities bucket. And I'm going to pick liquid benchmark underlyings and I'm going to look to capture sort of ebb and flow in the theme at large, which for my kind of macro vantage point is where I sort of lean to anyway.
Well said, my friend. Not even a caveat, just an additional point. I would agree with everything you said. I think in a down market, your correlations are going to head towards one. So, like, the disadvantage of being a sort of a professional money manager is you can't go to cash. Nobody's going to pay you 2% to just put their money in cash when they can get paid to keep their money in cash. So that's your disadvantage, which the retail investor does not have. The flip side, not the flip side, but what I would say is you can make relative bets. So you can do something like, let's say in my case, I like materials, and you can make that relative to the market. So you can normalize the size of the trade and you go long XLB, short SPY. So now you're looking at the actual relative performance of a sector versus the overall market. If you want to get cutesy or fancy or stuff like that, but in your case, or to your point, if correlations go up and those things start to move in tandem, in theory, making it relative with that short side of the trade can help a little bit to offset just getting blown up completely by being long outright in the sector. Yes. So that's one. Yes. And yeah, I think that's all. I would add to that. So then let me come around to the back end, which is when you see copper doing what it's doing right now, which is absolutely, going bonkers to the upside, which is somebody who's wearing a decent amount of Freeport right now. I'm not mad at this, and I kind of think
I would imagine not.
I would kind of think this is a theme that we're going to see, even if we get a down market, Ilya. It's sort of the way that I think about it is the Pavlovian response to react the way that we always react. It means I think we could be in an environment where we see real assets continue to run away. I think what's so interesting about this environment is I think the bottom 50% of the people, nobody wants to go through a recession. Nobody wants to lose their job. But I think we're at this point where it's almost unsustainable. It's almost unsustainable to have housing prices where they are.
Oh, sure.
And wages moving at the speed that they are. Groceries, I know eggs have come down a bit, but it's almost unsustainable. And the pain point, I always think about markets through the pain point. The pain point for a large swath of society is for this thing to just keep going. F you, we're going higher. Number goes up. And I think that just becomes this massive, massive pain point for the bottom 50%. Nobody wants a recession, but the pain that if number just keeps going up, the pain that brings in reduced living standards for more than half the world population, I think people don't think through. And I don't think there's anything stopping this train. I don't know what could happen that would change the Pavlovian response if we do see a growth slowdown. So anyways, that's why I like materials, not for what happens in a growth slowdown or in the case of a bear market, but in the case of what happens on the response. So I don't know, I said a lot there. That wasn't really a question, more of a statement. Back to you. What do you think's happening in copper? Do you think this is a response? Yeah, what do you think's happening in copper? What are your thoughts about it?
Well, so let's start with what I don't think is happening in copper. Obviously, people look at copper as something of a China proxy because China is the world's biggest buyer of copper. I don't think what you're seeing is a positive China story. Because if you look at what's going on, even the Hong Kong listed names, which were the beneficiaries of, as I argued weeks ago, the flowing out of money from China, not of some sort of optimism. I did this whole song and dance on macro money a couple weeks ago saying, if you're looking at Chinese stocks and you think this is optimism, you might be seeing the exact opposite thing. Because when you look at what's happening with mainland stocks, they are not rallying. Hong Kong stocks are rallying. FXI names are all listed in Hong Kong. It's following HSI. It's not following what's going on the mainland. On the mainland, ETF is ASHR. You have standstill. And when you look at the underlying cap capital flows, what you're seeing is money is flowing from onshore to offshore, from mainland to Hong Kong. And that's what's powering this. Sure looks like a bunch of money is trying to find a way around capital controls, rather than there being some sort of optimism in Chinese stimulus working. The money would be flowing northbound, not southbound. So, and thankfully, China has this Stock Connect thing. They'll show you the flows readily. It's available online. So you can go and see. HKEX is the group that runs the exchange. So you go and you see this and you go, okay, well, this copper rally isn't happening because people have bought into China's stimulus promises are going to work. No, it's actually the opposite in terms of people's assessment of China. FXI is now falling. The Hang Seng index that it's underlying, that's falling. Mainland stocks are shifting back down. Nobody is buying this China story yet. So whatever is going on in copper, it isn't a demand thing, seemingly.
What do you think it is? Hoarding in front of tariffs or something?
It feels like it might be. It feels like there is a lot of conversation about copper is another one of those aluminum and steel type of things where you can make the argument and do it unilaterally on national security grounds, and nobody's going to fight you on it. Like nobody's going to take that one to court. And so that might be something. That doesn't mean that it's wrong. And it doesn't mean that you can argue with the price action, which you can't. So when you look at, I think, what you see in HG itself, you're at an interesting spot, especially if you look at the continuous HG contract. You're at a pretty significant level of technical barrier here. And so how you resolve this will be interesting. If you zoom out here a little, you'll see that we're right around a major previous high. And you might have to go to a weekly here to really see it. This is a very auspicious level for copper. So, I mean, needless to say, we've spiked and faded hard from just right here, just last year. So, let's see. Maybe what this is, to your point, is the front running of April 2nd and whatever that means. And then speculation becomes reality. It turns out that the world hasn't ended and the sun will, in fact, come out tomorrow. And so this thing caves back in on itself.
All right, we got less than 10 minutes. I'm curious, because I can't outkick your coverage no matter where I go in the world. I'm curious, newly appointed Canadian Prime Minister Mark Carney called a snap election, man. So April 28th.
The great Mark Carney.
Looks like. We've only got 10 minutes, Victor. Okay. He called a snap election on April 28th. I know. So what's on the line here from the market and risk perspective?
I think it's really interesting. I think you and I would have agreed that before the Liberals picked their champion, that the Conservatives, Pierre Poilievre, was going to walk into this thing.
It was
much as Keir Starmer walked into the thing in the UK. Like Rishi Sunak was out there, like literally announcing an election in the rain. It's just, it was like, well, this guy, like, this is, if Hollywood wrote it, you would say this is too stupid because nothing would happen in real life like this. Mm-hmm. It's too dramatic. And then he does it. So we would have said the Conservatives have this thing in the bag. everybody in Canada absolutely despises Justin Trudeau. And so they're going to hand it to the Conservatives. This is done. And then savvy Liberals pick not somebody from the outgoing Trudeau administration, even though the Deputy Prime Minister, Chrystia Freeland, tried to burn her boss because she ostensibly saw the writing on the wall. People saw through that and said, well, this is just some opportunistic nonsense. No, we need somebody really different and completely outside of the Liberal Party establishment, somebody who's not even a politician, who's an economist and a central banker, and also somebody who is not afraid of a crisis, somebody who steered the Bank of Canada through the 2008 crisis well, and who steered the Bank of England through the Brexit crisis, again, well. So we need someone who, with all of this consternation with the U.S., we need somebody formidable. And the polls shifted immediately. Once he won, he is now a narrow favorite to win this thing. Ultimately, I don't think it really matters all that much, in the sense that I don't think either he or Pierre Poilievre are going to pursue that different of a policy. I think the main question is, what do they do in response to a sort of assertive U.S.? And I think both of them are going to essentially have the same position. Okay, it looks like you want to have a negotiation. Let's have it. And let's get to the other side and get a bigger USMCA and move on. And all the kind of sniping and saying things around in the media, that's not going to phase either one of them. I think they're just going to understand that that's what this game is. And if you didn't understand that that's what this game is, based on just the senators that were very anti-Trump and now are very much in his orbit, then you're missing the point. What the president says isn't necessarily what the president is going to say, or what the president means. What the president says is is a reflection of the goal he thinks that he's achieving right then and there. And then when the goalposts change, what he says will change. Look at what's happened with Ted Cruz. Look at what's happened with Marco Rubio. Look at what's happened with Lindsey Graham. All these loud Trump critics that are now very much in the orbit. So I think both Pierre Poilievre and Mark Carney certainly understand how this works very well. I think if Carney wins the election, markets are going to be relieved because they'll feel like, oh, somebody who's battle tested is going into this negotiation, which means risk of somebody getting emotional and being dumb is lower on balance. But I think if Pierre Poilievre wins, I don't think they'll think that he's some sort of reckless buffoon. He's not. So I think, and they were very much ready to vote him in just 2 months ago. So I think this is not a big deal, but on the day of, if Carney wins, maybe it gives the Canadian dollar a bit of a nudge higher. But really more about the event risk going away, I think, than anything. I don't think the market really thinks that either one of these candidates are incapable of having a meaningful dialogue with the U.S. I think they thought that Justin Trudeau was incapable, and he's gone now.
Here is my only caveat. Not even a caveat. Can Canadians participate in prediction markets?
I don't know if there's a law against it.
I think the reason I ask is it's incredibly difficult for a finance company to set up shop in Canada. And so I'm guessing, and I had read...
It is. It's very, very, very complicated.
I had read as of, I think, like at the end of 2024, that Canadians couldn't trade on Kalshi or any of the prediction markets. So there's some part of me that goes, because I don't believe, I think polls are sort of this reflexive tool to try to mirror back a desired opinion on the public in many cases, and especially in for big elections like this. So I lean more into the election markets. And so when I look at Kalshi, I'm like, oh, well, that's mirroring what a lot of some of the polling is saying in Canada. Mm-hmm. But the only little caveat I would have is I don't think Canadians themselves can put money into this market. And so it gives me a little bit of pause here. I wonder if there's more support for Pierre Poilievre that's being captured in these markets, but we're going to find out. And I love that we get to continually test these prediction markets against polling and against the eventual results. My good friend, we are coming up on time. Ilya Spivak, as I told you, I've got a list here, and I've got 5 or 6 more subjects I could have talked to you about. I appreciate your time and the wealth of knowledge that you provide. If people want more from that fountain of knowledge that you offer, tell them where they can go.
As ever, I am all over the network. You can brave the fountain of macro blathering all day long. Overtime and macro money are on the show in the afternoons, Mondays through Thursdays. We're here on Tuesdays. Chris and I do Futures Power Hour Mondays and Fridays. You and I are talking to Tom Sosnoff at the weekly market open on Sunday nights. I'm writing for the news and insights portion of tastylive.com. So if you don't get enough talking, you can always read it also. I am also out there on the platform formerly known as Twitter and on Blue Sky at Ilya Spivak.
My friend, if you want to follow me on Twitter, at Victor Jones is where you can find me. The Owen Jones is 0 because I like to be difficult. Again, another thank you to Ilya for the time as well as the knowledge. Thank you to all of you that are currently in the YouTube chat. I appreciate you. Do me a favor, if you could, before you get out of here, the easiest way to support the channel, the people in front of the cameras and all the people behind, is to hit the like button, subscribe to the channel. We'll see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Peace.
Peace.